Gains of 0.3%. Look for basic resources to be a lift there. DAX futures looking to add 31 points, and over in France, a lift maybe of 0.1%.
Okay, so looking for a little bit of positivity at the start of the trading day, then European equity markets could bounce a touch, and we looked at the US futures picture, and that did suggest that we'd see a little bit of positivity this morning. So the FTSE 100 opening pretty flat right now. The dollar index is just in retreat, a little down 0.1%. Interesting that the dollar index in retreat, but also the euro, as we have seen that data out of Germany did weigh a little bit on the euro, at least in the immediate aftermath, but maybe the market wasn't expecting anything much better in terms of the underlying economic story, even if that factory orders print did come in below expectations. A pretty mixed picture when it comes to European bond markets. Yesterday, we got a really clear picture. Yesterday, we had those comments from Isabel Schnabel. They were seen as more dovish than you would expect from someone who often leans hawkish, and we saw those yields dropping. Today, things look a little more nuanced, and we see movement in various parts of the curve creeping in to the GMM. A pretty flat picture for commodities, actually, this morning. Some of the headlines in that sector, perhaps around the corporate side of things, so the Rio Tinto story out of Australia, as we were hearing from Joe a little earlier on, perhaps one to keep an eye on. Tom, what do you see in terms of the sector breakdown?
Yeah, across the 12 main sectors, then it is basic resources that is really jumping out with gains of 1.5%. Again, we've seen iron ore prices and copper prices being lifted in the session today, and the basic resources gains is lifting the FTSE 100. Two sectors in the red. Energy by not much, as you were mentioning. Energy currently flat so far in the session. Food, though, and beverage down 0.5%. Some of the other strength coming through for financial services, getting around 0.5%. Tech also getting a bit of a lift, up 0.6. We've got a reminder that Apple getting back to that $3 trillion market cap yesterday with a gain of around 2% in the session. We're also seeing some gains for insurance, up 0.4. So a pretty bright picture generally across these sectors. The heavy lift coming through from basic resources. Two sectors currently in the red. The DAX, this is not reflecting the pricing of today, but of yesterday. The FTSE 100 adding, though, 0.3%. And across your benchmark, you up at 469 currently across the European stock 600, a gain of 0.3%.
Okay, so those are the sector moves, and yeah, overall up by 0.3% then. Modest gains across European stocks. Let's get into some of the market-moving themes. Sam Unstead joins us from the Markets Today blog and can talk us through his latest thinking. Give us your thoughts then, Sam, on this global rates debate, because as someone was just pointing out, we seem to oscillate almost daily between the higher for longer dominating or the cuts come sooner than we thought dominating, and these two camps sort of swap places.
Yeah, and actually, I don't see that stopping anytime soon. We've got a week this week that's dominated by data, particularly out of the US, on the jobs market in the US. Then we've got central banks, a lot of central banks. It's going to be a very big week for that next week. So right now, it feels like things have coalesced around, or certainly for today, it feels like things have coalesced around the central banks are done, and that we are now looking towards either higher for longer or when cuts are going to come. But you know, jobs data to come, central banks to come.
The shift in the view around the European Central Bank, it was something that Anna and I were discussing in the news meeting before the show, has been marked, hasn't it? You're bringing forward cuts to the first quarter, potentially 5 interest rate cuts of 25 basis points through next year. Isabel Schnabel played her part yesterday, but that turnaround has been significant.
Yeah, and really just in the past sort of 2 or 3 weeks, so you had that inflation reading. Inflation obviously has come much closer to target, and certainly, you know, in terms of the bets on who's going to cut first, it is 100% everyone believes it's going to be the ECB. Not only that they're going to cut first, but they're going to keep cutting. You know, there's now, I think it's 125 basis points of cuts are now priced in. We're nearly 150. So the question there will be, you know, are they going to cut earlier? Are they going to be the first to cut? If they're not, you know, do they do they keep restrictive policy in there for too long? Because the market certainly seems to have decided that a cut needs to come.
Yeah, you're right. I mean, 90% chance of a cut in the first quarter, so that is the consensus view. We heard a very different view in the first hour of the programme, which was interesting, but it's good to keep across all the views in the market. Let me ask you what's going on with Bitcoin then, Sam, because that feels like a story that perhaps we don't dive into as often as we did when money was cheaper, frankly. So what's going on with Bitcoin? It's hovering above 43,000, I see.
Yeah, I mean, the rally has just kept going for Bitcoin. I think still the thing underpinning the rally more than anything else
is sort of a 6-day rally.
Yeah, the thing underpinning that more than anything else is ETFs. You know, the potential that these ETFs are going to be approved, that's going to sort of mark this maturation of the Bitcoin and the cryptocurrency market. But it does feel like, you know, this new rally is also coinciding with these bets on Fed cuts coming next year. And so it may well be that Bitcoin is becoming part of that story, or one of those assets that you start to look at when you are thinking about the central bank story.
Okay, Sam, thanks very much. Sam Unstead from our Markets Today blog. You can get more from the team on the front page of the Bloomberg UK website or by typing TLIV Go on the Bloomberg terminal. Some corporate moves.
Yes, in the healthcare space, redhead crossing the terminal then. Merck, listed in Germany, I'll get there, GAA, Merck, KGAA. So the drug maker, of course, listed in Germany, seeing its shares drop around 13%, at least 1 point so far in the session. This is on the back of a disappointment in terms of late-stage trials for an experimental multi-sclerosis drug failing in late-stage trials, a knock, of course, to the German company's plans of creating another blockbuster, and so the stock taking a hit so far in the session. We'll keep across that story for you, Anna.
Yeah, that's something of a disappointment for many watching that particular space. Let's focus in on some of the other things that are on the agenda from an economic perspective today. Later this morning at 9:30 London time, we'll get the UK construction PMI reading for the month of November. Interesting pricing components sometimes to that reading. At 10:30 a.m, it's the Bank of England's biannual financial stability report outlining potential risks, with Bank of England Governor Andrew Bailey speaking at a press conference half an hour later. We then turn our attention to the US ADP employment data. That's at 1:15 p.m. London time, and at 3 p.m. UK time, the Bank of Canada rate decision hits the Bloomberg terminal. Bloomberg Economics sees the central bank keeping rates in restrictive territory for longer, despite the recent GDP miss. Then also later today, we will bring you lines from the US Senate Banking Committee hearing, featuring testimony from the CEOs of America's biggest banks. And certainly that is something we're going to home in on a little later in the programme, Tom. We'll get a briefing from our colleague Charlie Wells on what to expect as we see those banking CEOs take to Capitol Hill. We'll get a briefing from him. Plenty of data to think about today from the UK side of things on construction, which has been a lagging area of the economy, all focusing on the US jobs story. ADP due ahead of the payrolls data on Friday.
Yeah, and the payrolls data, I just clicked into the eco function of the terminal to get the survey and the forecast for that non-farm payroll print out of the US. Again, Mark Cudmore saying this could be a tripping point for this market rally that we are seeing. And the survey is that the print will come through an additional 187,000 jobs to be added in the month of November. The prior number was 150,000. There's been volatility, of course, around this number. But, of course, what the Fed will be looking for is continuing softness, and the JOLTS data, with all the caveats around how reliable that is, showing that at least the number of openings is closing, but the number of firings, or at least the number of companies letting go of jobs, is relatively small, which aligns with that kind of comfort factor for the Fed.
Yes, and I guess what we'll be looking for from the jobs report on Friday is are the cracks big enough to justify market pricing of cuts from the Federal Reserve, because that is getting closer and closer, isn't it? May now seems to be the month that many are looking to. Right, coming up on the programme, we will get an update on some of the movers today in the markets. British American Tobacco stocks burned by their latest revenue guidance, the pun intentional. We will look at the latest movers next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Welcome back. This is Markets Today, 11 minutes into a European trading day that shows very modest gains, up around 0.1%. US futures also pointing slightly higher, more so in fact. E-minis up by 0.2%. Let's check in on some of the individual stocks that are moving this morning. Joe Easton has a briefing. Joe.
So we've got Merck shares absolutely slammed over in Frankfurt in the opening trading. At the moment, down 13%. This is the biggest drop for that company since 2009. A huge move after their drug trial in multiple sclerosis misses the primary endpoint. It was expected to reach almost 3 billion euros in sales annually, according to some analysts. Now, Jefferies writing in an interesting take that potentially there weren't enough trial patients to make this data work for them. That is one take on that, but we're also seeing a bit of a read across in Roche and Sanofi as well in the drug space. They have similar multiple sclerosis drugs in the pipeline, and we're seeing negativity in both of those at the moment. TUI over in the travel space announcing a potential delisting from the London Exchange this morning. Also some pretty good sales numbers, but another blow yet again for the London Stock Exchange in terms of potentially losing that company. But we're seeing gains of around 6% on the back of those earnings at the moment. Then we'll flip over and have a look at a couple of the other stocks we had in Stocks Watch. Another big decliner is British American Tobacco. Weakness in the US, partly due to the macro, but they're also saying that they're losing some share in vapes. That has been hit by the proliferation of illicit products, according to their CEO. Today, you've already done that one getting burned, so I'm going to say that one getting smoked. Well, these puns becoming a bit of a drag, maybe. Now, Rio Tinto, that one up 2%. They did do some production numbers out of Australia in a investor day. Pretty weak on the copper, but the aluminium holding up, and therefore we're seeing those stocks gaining. Clariant, which is over in the chemical space, they are closing a production facility over in Romania. A bit of a shock, losing around 200 jobs. We're seeing that stock dropping around 1.3%. A potential for some earnings decreases on that one. 10 Entertainment, one we don't look at too much. This is bowling. It's a UK bowling company. Got a takeover bid, according to Sky News overnight. They're saying they have got a bid at a massive premium, and that stock up 32%. investors bowled over by that one. Then in terms of the ratings changes, an interesting note from Deutsche Bank downgrading Inditex. This is the owner of Zara. They say there's not much to look forward to in UK retail next year. Wage costs are high, and meanwhile demand is likely to come down due to the cost of living crisis. That one gets a cut alongside H&M. Volvo is downgraded over at Exane BNP Paribas following a rally for the car maker there. We've got an interesting upgrade for Ocado over at JP Morgan. They've been negative on that one for over a year due to their robotics factories that they said would be weak, but they've ended their underperform rating, upgrading that one to neutral. And finally, Morgan Stanley is negative on renewable energy in a note today, and they downgrade the Nordic producer Nel, saying that costs in that industry are too high. They don't like that space, and that one is dropping around 6%.
Joe Easton from our equity team, thank you very much indeed. Let's bring in Stephanie Niven now, portfolio manager who's responsible for the global sustainable equity strategy at 91. And Stephanie, we want to get your calls on the healthcare space. Joe Easton was talking about the travails of Merck and the challenges there. But before we do that, your call, your scepticism, your concern about the clarion call of the soft landing narrative, which is back in focus again today after the JOLTS data, and as we look ahead to non-farm payrolls on Friday, you are cautious, you are concerned about the soft landing narrative. Why?
Sure. I mean, I think all investors should be aware of this soft landing that's being priced in ultimately by the market. I mean, if we look back at history, if we look back at 1990, 2001, 2007, we've looked out for that soft landing and it's not occurred. And I think investors need to really think about the consumer exposure of the companies that they're buying and really consider about what happens as, you know, the rates begin to kind of bite, and we see that impact through jobs. You know, we're looking out onto Friday when we should see some really interesting job data. So ultimately it's about looking beyond those companies that are really exposed to the rate trajectory and thinking about what companies have structural growth, particularly those companies tied to sustainability challenges.
Okay, and if we do, good morning to you, Stephanie. So if we are not going to get that soft landing, how soon do the rate cuts come?
Well, you know, we're looking out to 2024 and perhaps the back end of 2024. And, you know, it's interesting looking at all the narrative around Europe. You know, we've already talked a lot about the flip-flopping that we've seen just in the last 3 weeks. And Europe's an interesting point. You know, we have both cyclical and structural challenges there. And I think that's what's causing a lot of that oscillation, a lot of that volatility in what the market's really expecting the ECB to do in the coming weeks and coming quarters.
To be clear, on the rate cut question, before we get into sectors and your views there, you think the markets are getting ahead of themselves in terms of pricing in, whether it's ECB 5 cuts next year or plus 100 basis points from the Fed next year? You think the markets are getting ahead of themselves?
It seems likely. It seems that higher for longer is, you know, where the central banks are heading us. And we want to position around that. We want to position around those businesses that can deliver quality earnings growth and aren't dependent on a cyclical rebound and aren't depending on rates. We want to back those businesses that have much more of their own destiny in their control.
Okay, and let's think about one sector that I know you've focused on quite a bit, and that's healthcare. And now we've seen incredible performance by the GLP-1 brigade, shall we call them. So this is companies within the healthcare sector that cater for diabetes and also increasingly weight loss drugs.
Yes.
And so this has become quite a frenzy, and I think maybe the chart that we just got on the screen, you know, will encapsulate some of that frenzy. But you flagged to us that if you show what's happening with those companies, and we've split those out in the white line there, you can contrast that with the broader healthcare sector, and actually it's not done great. And you see opportunity there.
Sure, the discrepancy between the GLP-1 exposed players and the rest of the healthcare sector is really quite shocking, and it's, you know, really opened up significant valuation discrepancy and real opportunities for those prepared to look beyond that GLP-1, you know, real interest and hype. I mean, GLP-1s are fantastic medical development. You know, it's really interesting the sorts of problems and solutions that perhaps, you know, that class of drugs really brings into particularly the US healthcare system. But it's just one tool in a medical toolkit. And we see a lot of opportunity to thinking more about preventative medicine in other areas, or even in the medtech sector. And, you know, there's some really exciting names like Edward Life Sciences, for example, that have been beaten up on the back of concerns that GLP-1 effectively mean that everyone becomes, you know, obesity was a thing of the past. It's not going to be that straightforward, and there's going to be opportunity across the board, and GLP-1s would just be part of the solution more broadly.
You have a lens, of course, on sustainability. Sure. We're at COP28 this week. As you look to next year and as you reflect on this year, how challenging has it been to make the case for investing around sustainability this year, given the pushback around ESG? And do you think that narrative changes next year?
Sure. I think, almost we're at peak negative sentiment this year. We've seen a lot of, media around, ESG and whether it's, a valid concept, a valid way to think about stock
analysis. It's not just media. I mean, ESG has underperformed.
Well, it depends if you think ESG is even an asset class,
okay.
Right? The sorts of businesses we want to invest in are those that have solutions, products that lean into sustainability challenges. And you're right to bring up COP28, and it's really interesting to see the degree of conversation that's really happening on the ground in COP28. And 2023 we've seen $1.7 trillion of investment in climate. That's a record-breaking level, but it's still far behind that 6 to 10 trillion we need to see annually to drive towards net zero. So that investment opportunity is where we see structural growth, and businesses that can deliver that structural growth with a competitive advantage make really attractive investment proposals.
Do you see anything coming out of COP, Stephanie, that suggests that the money is getting to where the money needs to be? More of the money is getting there to fix these problems?
So we've begun to see a bit of focus. We saw the UAE announce their Altera 30 billion investment fund, which thinks about climate financing. And particularly interesting was the focus on EMs, where a lot of this investment needs to be made. Climate and decarbonisation can't be solved by just thinking about DMs. So I think having those sorts of grown-up conversations, and as 91, we've had a number of senior delegates on the ground out there at COP, and really sort of being part of that conversation, thinking about mobilising climate finance to really unpick and try to solve some of these issues that we have to deal with right now.
Stephanie, thanks very much. Thanks for joining us. Stephanie Niven, Portfolio Manager at 91. Coming up on the programme, the EU is looking to delay tariffs on UK electric vehicle trade. We will get the latest details and the implications for the sector. That's next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Authorities could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. Happy Wednesday. This is Markets Today. 23 minutes into your European trading day. You're seeing gains of 0.3% across the European Stock 600, the benchmark here. Now, Bloomberg has learned that the EU is set to recommend delaying tariffs on electric cars traded with the UK by 3 years. Current post-Brexit arrangements are meant to kick in from January the 1st. Let's get the details then and bring in Bloomberg's Kazar, Craig Trudell. Craig, how did we get here? I guess the question is, the answer to that is Brexit. What is the purpose of these tariffs? It serves no one, surely. And what extent, how much clarity do we have that they are actually going to be postponed?
I think it was a real concern and remains a real concern that we still do not have resolution. This is a positive indication that, we're headed in the direction of avoiding a situation where in the new year, EVs will be subject to tariffs that combustion engine vehicles would not be subject to. It would obviously run very contrary to where the UK and the EU both want to see their auto industries going. But this did come from a good place, much as it has the potential to end up in a place where they wouldn't want to see the industry headed. The fact that the EU and the UK both want to see the EV and battery supply chain localized, that's of course what the US wants as well. And we just saw last week, an attempt on the part of the Biden administration to formalize the IRA, ways that they're going to define foreign entities of concern and what's okay and not okay in terms of how you source batteries and components and materials. But the goal here was to really sort of set up the supply chain in Europe and the UK. And obviously that's running behind schedule. We've had, the energy crisis, cost of living, and just, the sheer, reality of how much time it takes to set up manufacturing. It takes years.
Okay, so the point of these tariffs was to try and encourage Europe's battery supply chain, but that's still some way off. So maybe you delay the tariffs in the hope that more production comes through and to keep these costs down for consumers, as you say. So what's the broader impact of this story then, Craig? I mean, where does this take us?
Yeah, I think there is a concern on the part of, I think France in particular has been articulating this concern of if we sort of kick this can down the road, will the supply chain ever be set up here? I think, that's a fair question to ask, but I do think it's the case that we're seeing quite a bit of investment being put into Europe, maybe not as much into Europe, maybe not as much as we would like, and maybe not as much as has been lured to the U.S. just the last couple of years because of the IRA. But I do think that, we're seeing, even companies like CATL, China's, really dominant battery supplier, they're setting up quite a bit of manufacturing. We're seeing Northvolt, one of the more promising startups in Europe, getting going. So, this is a case of, it's going to come. We just need to practice a little bit of patience. And it is a matter of also, the automakers are going to have to source slightly more expensive batteries that are made here versus what are made in China. So, we need to sort of, let the markets play out and let, the output scale up so that those costs do come down.
Maybe there's a price impact as a result of that. Bloomberg's Kazar, Craig Trudell, walking through that important story around the EV business and tariff negotiations. Thank you. Coming up, Russia's oil revenue booming despite Western efforts to sanction Moscow's exports. The details next. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. Stocks get a boost as traders ramp up bets the ECB will add to the global easing trend. The US jobs slowdown feeds expectations of easier monetary policy. Vladimir Putin visits the UAE and Saudi Arabia today. We discuss the agenda for the Russian president as he makes a rare trip abroad. And shares in Germany's Merck sink as much as 14% after its experimental multiple sclerosis drug fails in late-stage trials. Tom, the broad market theme, then away from that disappointing corporate news flow, the broad market theme is around how soon the rate cuts come and how extensive they are next week. And in fact, we've had some developments just on that just now. Traders now pricing in 150 basis points of cuts from the ECB next year.
Which is remarkable, the turnaround and how quickly that's come in terms of the pricing around the ECB and when those cuts come through. Markets expecting the first cuts to come through in the first quarter. 150 basis points by the end of 2024. Will the ECB deliver on that? The comments, of course, from the traditionally hawkish Isabel Schnabel yesterday, setting this in motion. We look, of course, and continue to keep across what's happening in the bond markets and euro-dollar on the back of this repricing. Across your equities market, though, we continue to grind higher, and the central bank story is, of course, fundamental to that. Gains of close to 0.4% across the benchmark here in Europe as you look to cross that 470 level. The DAX, which hit a record yesterday at 16,533, builds on that gain with adding 38 points so far in the session. The FTSE 100 lifted today by the story around basic resources, on that lift coming through from iron ore and copper prices back above 7,500. The FTSE 100 adding 32 points in the session today. Let's flip the board and have a look at the sectors then as we talk about the basic resources story, which the last time I checked was the biggest gainer across your sectors, and there it is across the 12 sectors that we pull out for you. Basic resources adding 1.7%. Energy is flat. Health is down 0.1%. Merck will be the drag there, dropping double digits, and we unpack that story for you in the next couple of minutes. Food is also one of the leading loss makers across your sectors, if not the biggest drop coming through. For food and beverage, 1% is the move there. That is the picture then. It's mixed, but again, across the top line, the gains of 0.3%, gaining and grinding higher. Financial services worth pointing out as well, and tech both up around 0.8%. Apple on the read across there, with Apple getting back to $3 trillion market cap with an add of 2% yesterday, and that feeding into the optimism around the tech space as we expect yields to go lower on that pricing from the ECB. The benchmark adding 0.3. Here in the UK, the FTSE 100 back above 7,500, up 0.4%. Anna.
Okay, so yeah, basic resources, the best performing sector across Europe today. The iron ore price moving higher, the China story perhaps getting a revisit there. Let's think about the European economy, though. EU finance ministers are expected to discuss a set of rules aimed at reining in member states' deficits and debts at a meeting in Brussels this week. The proposal would see countries forced to cut debt as a proportion of output while leaving space for green and defence investments. We're joined now by Bloomberg's Maria Tadeo in Brussels, who's been following all of the build-up to this story. Maria, good morning. What do these proposals entail then?
Well, Anna, the fact that they'll be able to rein in a deficit and debt while also spend on issues where we know the European Union says it wants to be ambitious, like climate, like defense. Obviously, there's a lot of talk about an industrial policy. To me, seems a very, very difficult one to balance out and square, because fundamentally you're being told to spend to modernize your economy, but at the same time we know the pandemic era is over, and now, of course, the fiscal rules will come into play from next year, so that means you're going to have to reduce or see a form of structural reduction of both deficit and debt. That is fundamentally beyond the numbers and the specific targets, really the crux on the core of the debate, and this is why this is such a difficult topic too for finance ministers debating this. Nonetheless, Bloomberg News has a draft version of the proposal that will be debated tomorrow by finance ministers, and there are some elements that are now projected to take place if agreed to appease the Germans, which have said they do want to see now structurally their benchmarks, potentially even 1 percentage point over the adjustment period to reduce the debt charge of every country to show that this is becoming structural. Having said that, when you look at these benchmarks, to me tomorrow it will be a very long discussion, and it is not clear. And fundamentally, this is a question beyond the numbers, how you have an economy that clearly now wants to show it's treating the fiscal story seriously, that it will bring down debt and deficit sustainably. We also the jitters in the French government on Friday while they were waiting that credit rating decision. They were thinking there could be a downgrade because of the fiscal picture, but at the same time enact this very ambitious agenda of climate, defense, and new industrial policy.
Which are all big ticket items, of course, as you have illustrated in the past, Maria, with your own reporting around that need to retool the European economy and continue to spend on defence, particularly given Ukraine. How likely is it that this deal then gets across the line, Maria?
Well, look, the pressure is certainly on because we're at the end of the year, so obviously we know this is Brussels. In a week from now, everyone clocks out until January. Essentially, in principle, this would be the last year group of the year. This is something the finance ministers have to do. It's not even the European leaders that have to agree to this. It is so technical that this is seen as a finance ministry duty to all of them. So the clock is ticking. They also know they have the pressure from the European Central Bank. We're already seeing big moves in markets. It is clear it's volatile. The data, the European data, today you had those German numbers. It is obvious that it's bad and the weakness persists. The European Central Bank insists this fiscal rules reform could actually instill credibility in the European agenda if they get to a good compromise before the end of the year. But to me, one of the key points will be the position again of the German finance minister, because Mr. Lindner, who, remember, he told me he defines himself as, quote, the friendly hawk. He's been tarnished at home because of the budget mess. He now has to show to his domestic audience, but also his voters, that he remains a man committed to fiscal discipline. Does he mean that tomorrow he's more inclined to go to a compromise, or actually he will double down on some of the tough lines that we know are non-negotiable for a number of countries in Europe?
Well, as Linda, as you know, of course, debates their very own budget in Germany as we speak. Maria Tadeo, thank you very much indeed in terms of the context with the negotiations going on in Brussels around the fiscal story there. Let's get to some of the other top red stories on the Bloomberg terminal then today. Israel has rebuffed mounting international pressure to halt its military campaign in southern Gaza. The United Nations warns there is now no safe place in the territory. This as Israel's military has encircled Gaza's second largest city, Khan Yunis. The Hamas-run health ministry says over 16,000 civilians have now been killed. Amazon is sharply cutting fees for merchants selling cheap clothing, a sign that it's hunkering down for a price war with Chinese fast fashion upstart Shein. Amazon says it's reducing seller fees on clothing products priced below $15 to 5%. That's down from 17%.
Apple is once again a company with a $3 trillion market cap. Its shares rose more than 2% in the US yesterday after a strong forecast from iPhone assembler Honhai. Apple stock is up nearly 50% this year. Vladimir Putin is visiting the UAE and Saudi Arabia today, a rare trip overseas for the Russian president. On the agenda, issues including oil trade and investments, as well as Israel's military campaign. At the center of discussions in Riyadh will be Russia's role in the OPEC Plus grouping, which last week agreed to extend and deepen production cuts.
Now, staying with that subject, Russia's monthly income from oil exports is now greater than before the invasion of Ukraine. President Putin has been able to fill his war chest despite Western sanctions designed to curb Moscow's ability to cash in its vast oil reserves. This is the subject of today's Bloomberg Big Take. Very pleased to say we're now joined by Bloomberg oil trading reporter Alex Longley. Alex, how then has Russia been able to get around these curbs?
So what we've seen in the oil market since these sanctions came in place are really two prices for Russian oil. One at Russian ports where they sell it, and that's what the sanctions targeted and said, we won't let you use European, US services above $60 a barrel. And then the price at the point of sale in India and China. And what you get in between that is a gap. So you'll see $60 in Russia, you'll see $72 or higher in India and China, and that middle bit disappears. And the question is, where is that 12 or however much it is dollars a barrel spread going? And we found in our story that about $11 billion worth of money is just disappearing. And the issue here is we don't know who those middlemen are. We try to contact them. We try to follow the shipping companies, the insurers, the traders in between, and you just can't find who they are, which raises the question of if they're not identifying themselves, well, where is this money going?
Okay, so that's an open question. So what impact will the emergence of this shadow fleet then have longer term? Because we've seen, I mean, I think other countries have used shadow fleets when they've been sanctioned. I'm thinking of Iran, but Russia is a very big player here, and now we're seeing, you know, environmental concerns growing as a result of this ill-maintained shadow fleet that's now increasingly in use. What do we know about that?
Well, there's a few things. If you talk to people in the shipping industry, they'll tell you, oh, this is nothing new. Iran, Venezuela, as you say, have been operating kind of shadowy tanker fleets for a long time. The issue here is this is becoming entrenched. Russia is such a big exporter. It needs such a big provision of services, not just the tankers, the insurance, all the paperwork that goes around that. And as these sanctions sort of fail to crimp the exports, as ports continue to take tankers from the dark fleet and take more tankers than they were when it was just Iran and Venezuela, the issue here is it becomes more acceptable to have substandard insurance, substandard tanker quality. And what that then means, as you alluded to before, is there's a huge environmental risk here. My colleagues went to a bay in Greece. There's a small tourist town next to where two really old ships that are beyond their lifetime, really, should be scrapped by now, are conducting clandestine ship-to-ship transfers. And the risk there is you have a spill, and before you know it, on the shores of Greece, you have black sludge on the beaches.
Yeah, it sounds like from that reporting it's more a case of when, not if at this point, the environmental damage that's potentially being lined up there. This is really worth your time, the big take of today. Alex Longley and team doing some really smart analysis and reporting around this story. A couple of headlines to bring to your attention, particularly in light of what we've seen in terms of lower yields, money into German and Eurozone sovereign debt on the back of Isabel Schnabel's comments yesterday that she sees no additional hikes coming through. Well, the ECB's Kazaks, the governor of the Bank of Latvia, and of course a board member of the European Central Bank, pushing back to some extent, saying, and this is the key line, currently no need to cut rates in the first half of 2024, so pushing back on the market pricing, which, as we know, has now adjusted to 150 basis points in terms of expectations of cuts coming through for next year. Kazaks of the ECB, of the Bank of Latvia, Central Bank of Latvia, saying no need currently to cut rates in the first half of 2024. Plenty more coming up. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. they're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Markets Today. We are 44 minutes into our European trading day. European stocks are a little bit stronger this morning, just up by 0.2%. US futures have been pointing a little bit higher. Nasdaq futures up by 0.3%. Now, the CEOs of the big US banks are heading to Capitol Hill today for the annual oversight hearing. They are expected to make their case for watering down rule proposals they argue will harm the economy. Let's get to Bloomberg's Jenny Serene for more and who can preview what to expect. Jenny, good morning to you. I guess we would expect to hear that kind of pushback against regulation from this sector. So what should we expect to hear then from these Senate hearings today?
Yeah, no, I think exactly what you said. We're expecting these CEOs to really bang the drum on capital rules. They're very upset about a raft of proposals that U.S. regulators have said they want to introduce in the coming years, and so they're really looking to make their case. I think the best part of these hearings, though, is that you really never know what to expect. The senators can kind of come out of left field and ask them anything they want, and so these CEOs spend lots of time preparing for kind of anything.
Yeah, the sound bites can come from the people on the panel, or it can come from those asking the questions, can't it?
We look for the colour from that, certainly, and often there is colour. When it comes to, help me understand what's going on. The banks have been cutting headcount left, right and centre. You've talked to us about the fact that it may not be done across the banking sector, and yet Goldman Sachs is hiking comp. Good news for employees at Goldman. Does it spell, is there a turnaround in sentiment? Is there a broader takeaway for those working in this space?
I think, so Goldman yesterday said that they might be setting aside a little bit more in compensation. I think it might be a one-off just for Goldman, though. So this is a bank that has faced a lot of pressure, lots of public sniping after bonus payouts last year were pretty measly. And so I think this is something that they feel that they have to do in order to kind of get back on the right foot with their employees. I'm not sure that it's going to spell big paychecks for the rest of Wall Street, though.
Jenny, thank you very much. Bloomberg's Jenny Serene with the details there on the banking sector stateside. We'll be covering the Senate testimony across TV and radio, of course, and on the Bloomberg terminal. You can type TLIV GO to find the live blog for that. Let us get to another corporate story this morning. Shares in Germany's Merck are sinking after its experimental multiple sclerosis drug fails in late-stage trials. Let's get more from Bloomberg's Tim Lowe, who's got the details. Take us through then, Tim, the significance of these disappointing trial results.
Yeah, for Merck, it's a real blow. This is a company that was expecting this to become a new blockbuster and really drive growth over the next few years. They and investors were really expecting good results from this trial. One analyst even mentioned even the bears were thinking that in worst case scenario, it would only be like sort of better than the previous therapies. But it turned out it is worse. And so we're talking 2.5 billion euros a year of future revenue that might be evaporating this morning. For Merck, this is just another kind of black eye. It's a company with 3 divisions. It tries to, one's in electronics, one kind of helps labs and pharma companies with supplies. And both of those are struggling due to a collapse in demand for COVID products and also the downturn in semiconductors. So, Merck,
okay,
yesterday,
sounds like we have connection issues, but you're back, which is good. Sorry, we had connection issues, Tim, but you're back. So let's finish. Well, let's move on to the next question. You asked that brilliantly. You dropped out for a bit. We're back with the next question, which is, and you touched on this, the challenges for Merck more broadly. How do they respond to this? How do they make up for this shortfall?
Yeah, two things jump to mind. They still have a late-stage cancer drug. Data should come out in early 24. So the pressure on that is just ratcheted up this morning. Beyond that, they've been saying for over a year now, they're sitting on a pile of about 20 billion euros for M&A. They've been looking left and right for deals. They haven't specified whether that would be, a pharmaceutical product or electronics. Probably now the pressure is hyped up that it's going to more likely be in the pharma space. Of course, that also, with urgency comes questions about whether they go out and overpay for something. So I think investors are going to be with some concern about that. But the good thing is they do have this pile of M&A firepower that they've been talking about.
Okay, so that's the story around Merck. Tim, does this Merck trial failure then around this highly anticipated drug, does it affect other companies? Are there other players in this space?
Sure, yeah. This type of drug, it's called a BTK inhibitor. Sanofi and Roche also have similar medicines and trials. All three of them have had some issues with liver safety in the trials. So the read across has been pretty one-to-one. So investors right now are definitely looking at that. Does this spell bad news for Sanofi and Roche? Kind of curiously, the drug that this was compared against is an older Sanofi MS drug, and it actually performed better than expected in this trial. That was sort of the weird curveball here. So investors are also trying to digest what's going on there. Is this existing Sanofi drug actually more effective than we realized? Maybe it'll be harder to displace. They could kind of shake up the multiple sclerosis space in the years to come.
Okay, really interesting. Bloomberg healthcare reporter Tim Lowe. Really appreciate the insights there on that story and the implications for Merck and Co. Coming up, has the Treasury rally gone too far? We're going to talk yields and rates. That is next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today. We are 53 minutes into our European trading day. You can see that stocks are just on the front foot this morning, up 0.25%. US stocks also, E-minis, up by 0.2% in US futures. Let's talk about what's happening in these markets. Ben Ram joins us from the Markets Live team. Let's take a broad view of the bond market story then, Ven. In terms of the global story, extreme bond market positioning heralds pain trade, so says your recent macro view. To take us into the relative demand for bonds versus stocks.
Absolutely, Anna. So if you look at the positioning in the bond market, I mean there is a huge demand for calls. Obviously, those positions would benefit if bonds, treasuries start rallying, and the ratio of calls to puts on treasuries is about 2.5 times. That gives you a scale of the conviction that the markets have. That look, the end of the bond market route is near, and we are all positioned for the bond markets to rally because there is disinflation and yada, yada, yada. On the other side, if you look at the equities, you've got call options that are far less in scale than put options, meaning investors are thinking, look, you know what, the stock rally has run too far, the melt-up in valuations has gone too far now, maybe there's time for a pullback, and that's what traders are positioning for. Taken together, this shows that the markets are saying, look, the Fed is definitely done with its tightening campaign. We need to prepare for the loosening campaign next year. How far that narrative goes, we'll need to see, because we've got disinflation, but we still see strength in the labor market.
Are you suggesting, Ven Ram, that equity investors are being more rational at this point than bond investors? I'm looking at, because the other piece looks at whether or not things have run too far, essentially, and this ties into what you've just been discussing on the back of Anna's question. And the 2-year, 4.59 now in the US and 4.17 on the 10-year. How much is priced in along the curve at this point?
Pretty much all the good news is priced in, Tom, along the curve, because if you look at, we got the pretty weak Joel's data report yesterday, and even so, the rally in treasuries couldn't go further, and that shows that the markets have attained equilibrium, short-term equilibrium at this point. Those are the levels that you mentioned around there. I don't think treasuries are going to rally much more from here. I do think that the next 25 basis point move in the markets is going to be a leg higher in yields, and maybe that will come about from labor market data this Friday.
Absolutely. That's something we'll be watching. Ven, thanks so much for your time. Ven Ram from the Markets Live team, setting us up nicely then for that data point on Friday, non-farm payrolls coming in, of course. Remember, you can get analysis from the Markets Live team, Ven and Mark and all of the guys who write for that blog. You can go to the MLIV Go function on the Bloomberg terminal. A lot of movement on the ECB story just in the last couple of days, Tom, as well. We've been watching that weighed on yields yesterday, not having quite the same impact today, but some pushback to market pricing from Martins Kazaks, certainly worth watching on the Bloomberg terminal. That is it for Markets Today. You can get insights from us and the team. If you go to the Bloomberg UK website, you'll find the Markets Today blog, or type TLIV Go on the Bloomberg terminal. The Pulse is up next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to
let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Through the noise. Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Danny Berger in London and for Francine. Here's what's coming up on today's program. Stocks get a jolt. European stocks rise and U.S. futures point higher as jobs slow down in America boost hopes of lower rates next year. Traders, meanwhile, fully price in 150 basis points of ECB cuts in 2024. Vladimir Putin visits the UAE and Saudi Arabia today. We're going to discuss the agenda for the Russian president as he makes a rare trip abroad. Plus, CEOs from the biggest banks testify in Washington today before the Senate Banking Committee. Bank of America CEO Brian Moynihan says he sees signs that the U.S. economy is slowing, but still expects a soft landing. Well, it's that soft landing hope that continues to juice this market is the everything rally, and it continues for the most part throughout Europe today. We're continuing to see most of these equity markets move higher. Germany's DAX traded at a record yesterday. It continues to move higher despite Merck, those shares falling more than 10% today. UK stocks up 1/3 of 1%. So overall, the rally continues. And what gave us that next leg higher yesterday was the jobs data. Now, the big number comes on Friday, but in the meantime, we had jolts come in. That is job openings. It slows down to below 8.8 million. The coolest, again, since some time in a few months here. Sure, it might have been partially done because of the labor strikes, but even so, the market has taken this narrative and has run with it. Mohamed El-Erian says that the Fed is in danger of losing grasp of that narrative. It is an issue of them essentially not being able to tighten conditions if they want to by just job owning anymore. So let me walk you through these markets. Continue to see an equity market rally both in Europe and American equity futures. They're a little bit softer today. They play catch up today, up about 0.2%. European stocks just hovering around a 4-month high. The bond market also had a very strong rally yesterday, again, predicated on that JOLTS data. But has it gone too far? If it has, then the only direction is higher for yields. That's what we see today, just ever so slightly. We're basically unchanged. Does Friday shake that up with the jobs data? Meanwhile, really one of the cleanest ways to look at what's happening in Europe with 150 basis points priced in for cuts next year is euro versus the yen. We also heard from the deputy BOJ governor hinting that we might be near the end of negative rates. So you get the euro versus the yen falling yet again. It was falling more severely earlier in the day, but now it's down just about 0.1% versus the yen. But still, this thing has been falling for 6 days now. That is the longest losing streak since 2018. All right, so a lot of the concern here is, have we gone too far in this? Now, Citi's economists just recently put a note out saying that we've seen an improvement in key measures of inflation while labor markets have remained tight. With these upside surprises, the probability of a soft landing for the global economy has also risen. Even so, we cannot convince ourselves that we're entirely out of the woods. So what does that mean for your markets if we're not entirely out of the woods? Joining us for more on this is Elise Badoy, head of UK, Europe, and Middle East equity research at Citi. Elise, really great to see you this morning. So that's the view from your economists. If you can't be totally positive that we're not out of the woods yet, do you want to fade the most recent equity rally we've had?
Hi, Danny. Well, I mean, the key is to first of all look at the reasons that have driven the rally that we've just seen. It's obviously that a number of risk factors have abated, but have not gone away. I think that's what we're saying. What the European market is pricing right now is essentially, we believe, EPS down some 5%. We at Citi believe that EPS should be more in 2024, growing at around 3%.
Okay.
So I think it's this disconnect between, we actually have a relatively bearish view on the macro in Europe, but obviously it's what the equity market is pricing. And there's three factors that have been really weighing on the equity markets, higher rates, obviously it's fading, we now have an outlook for rate cuts. Secondly, geopolitical risk, we're seeing a de-escalation, they're not going away. And then thirdly, more news for soft lending. I'd mentioned PMIs, for example, bottoming.
Right. But how much, though, of a 2024 equity rally is predicated on cuts next year of 150 basis points of 2024 cuts?
I think some of the easing, obviously, of these policies and cuts coming through is important. But the market is also moving away, and there's a lot of questions around inflation, obviously, and cuts happen for the right or the wrong reasons. So it's this permanent tension between, yes, cuts there will be, but are we cutting because the economy is going so bad in a way,
right.
Or are we cutting because we're just seeing the problems going away, like inflation? And I think that tension is going to be really important, and our investors, our clients, tend to be looking at really these key factors. So watching inflation, it's coming off, but why is it coming off?
I mean, but you look at something like Germany's DAX, for example, which is trading now at a record new high, and then you have German factory orders come in today. I think the drop was something like 3.7%. The expectation was a drop, but not nearly that much. I mean, you look at that and you say, do the fundamentals match? If there is this weakness in German industry, and Germany's DAX, of course, is very cyclical.
I think we need to distinguish, obviously, between the macro news and, again, what's priced in.
Okay.
And I think there's a really, that's where the disconnect is. We still see overall the European market up 10% from here. We had called for this rally, essentially, that we've seen in the last few weeks. And I think that's because, the market was really pricing in something much lower. Where we are right now, in terms of, positive upside and surprises, is, it's essentially looking at, PMI is bottoming. They're still low, but they're bottoming. And bottoming is the signal to buy, essentially.
Right.
Now, another factor that I haven't mentioned is obviously the hope for a China recovery.
Yeah.
And that's massively important for Europe. We all know that Europe, the European market, is not a proxy for European economies, but obviously has a major influence from the US and from China. So whatever happens in China also matters. And again, there we're not out of the woods. Investors haven't seen really what they want to see yet, but we're seeing some positive signs. For example, the latest news on real estate in China.
I mean, it is just really hard to wrap your head, though, around the Chinese data. I mean, you get one set that looks positive, another one looks bad. Is it going to be more about actually seeing the growth happen in China versus stimulus kind of hopes of this before you can price that into Europe?
Effectively, investors are really, really wanting to have more data with China, and just stimulus news seems like it's not going to be enough. That's certainly the feedback we get. So I think seeing more of that will be good news. But however, when we look at the various sectors that we recommend, we think that initially any better news might come and be priced in through metal and mining, even before it comes through luxury goods. And I think that's reflecting exactly just what you've said.
You know, it's interesting because I had a conversation with Deutsche Bank's chair last week, and part of what we talked about, and I mean, he complained about, I should be more accurate, is just how European banking prices just have really struggled to keep up with the rest of the broader market. They have obviously very different issues from their American peers. But what do you make of the sector next year? Also, if they're potentially losing that juice of net interest income from higher rates, is there still further to go and maybe even some catch up to play with European banks?
So we have a neutral rating on European banks, and that's pretty much because we've observed all the points you've just made. And I think, you know, if you look at valuation, obviously they're not very high, but we do have some headwinds, you know, rate cuts. I'd mention also the consumer, obviously. We haven't talked about it, but one of the potential risks that could materialize, we haven't seen essentially any big issues with financing, with personal financing issues. And in fact, you know, we've had almost like this pent-up demand trade, and retail has done better than investor has thought. All of that means the consumer could have a blip. It's possible in Q1, Q2. There is this school of thought that actually we've moved from Q3 issues into Q1 rather than no issues at all. And that isn't great either for banks.
Yeah, certainly isn't. Elise, I'm afraid we're going to have to leave it there. Thank you so much for joining us this morning. That is Elise Badoy, head of UK, Europe, and Middle East equity research at Citi. Now, I mentioned this earlier in the show. I just want to give you another check on it because Merck shares are getting hammered. It's the German pharmaceutical company. Now, this is the biggest drop since July 2009, down 14%. The company's experimental MS drug has failed in late-stage trials. Hence, it's getting hammered today, down 14%. All right, coming up in the program, speaking of Germany, the government there is trying to plug a 17 billion euro budget hole next year. Can they seal a deal before Christmas? We'll have that for you next on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
EU finance ministers are expected to discuss a set of guardrails aimed at reining in member states' deficits and debts at a meeting in Brussels later this week. Now, over in Germany, Chancellor Olaf Scholz says he expects rapid progress on coalition talks on how to plug a 17 billion euro hole left in next year's budget. Here with the details, it's Bloomberg Germany correspondent Oliver Crook. And Oliver, it's been a difficult road for Germany to get these budget negotiations done. Where do they stand at the moment?
That's right, Danny. And they were going to finalize the budget for next year literally the week where that court ruling came out and just blew everything off course. And now we understand there's a 17 billion euro hole in their budget for next year. And again, the important context here is that this is a government composed of 3 different parties with 3 very different priorities. And those differences could kind of get papered over when you had a few billion euros to throw around. When those are gone, that's when the negotiations get really difficult, and they're at it. They need to get it done basically immediately, if not sooner, for their political purposes, but really they want to leave this issue behind them in 2023. So there's going to be spending cuts, there's going to be subsidy cuts. Where they're going to come is really the big question, and that's what they're trying to negotiate. We do not have a timeline for when they can get it done. If the cabinet can agree to this in the next couple of days, they can get it done by the end of the year, but that is not at all a guarantee.
I mean, potentially making things worse. It's not like the macro environment is fantastic for Germany either. About an hour or so ago, we had those Germany factory orders, maybe 2 hours ago. I mean, really bad, Oliver. It was a huge miss. We were just talking to Citi about them, who said, okay, perhaps the bad economic data is already priced into this market. But, I mean, this is certainly not what we were expecting in terms of just how bad it would be.
Exactly, and this is really backward looking. So this is October. We had down year-on-year 7.3%, month-on-month down 3.7%. But Danny, we also got construction PMI printed this morning. We had a 36 print on that. There's been basically 1 print lower than that in the last 10 years, and that was during the height of COVID. That really shows you how gloomy this economy is. And when you think about how the budget crisis really works into this, for a lot of businesses, what do they love more than anything, Danny? Certainty. What does this create? A huge amount of uncertainty, right? So this is going to be a question of where they're going to be placing their investments next year. If they don't know where subsidies are going to come, how do they know how to place that? And we see it in the data. IFO had a study out this week saying that businesses across the board in Germany are reducing investment into next year. And there's going to be an economic consequence of that, right? We have Deutsche Bank. It was supposed to be the year that came back in terms of growth in Germany. Now Deutsche Bank, as a direct consequence of this budget crisis, expects contraction yet again next year in Germany.
I mean, Oliver, it's kind of crazy to hear you say this, then also say in the same breath, literally like the DAX just hit a new record and is still moving higher today. I mean, is there not some sort of like disconnect here between what's happening?
Totally. I mean, the fundamentals, again, are just are completely disconnected in the market for what we're seeing in the economy. The economy really couldn't be gloomier. The thing that's interesting with Germany, and this is kind of the contradiction and kind of the issue with Germany, is that no one is expecting the sort of German economy to go out with a bang. It's going to go out with a whimper. It's going to go out sort of slowly. And so you can have this sort of grind on. And again, you know, there's also the alchemy of central bank policy and rates and all of that that's going to basically be driving the equity market. But the fundamentals for the German economy are just basically very, very poor at the moment, and this is what the government needs to deal with. And it comes back to the debt brake. You're looking at it on the screen, the amount of borrowing that they can debt finance in order to get this economy going. Habeck, the economy minister, says that basically Germany is boxing with its hands tied behind its back as a result of this debt brake when the rest of the world is debt financing growth.
Hey, Oliver, we won't tell Powell and Lagarde. You've essentially said central bankers' jobs is equivalent to an alchemist. We'll keep that a secret between you and me. Oliver, thank you so much. That's Bloomberg's Oliver Crook in Berlin. All right, elsewhere in the EU, Bloomberg has learned that the EU is set to recommend delaying tariffs on electric cars traded by the UK by 3 years. Current post-Brexit arrangements are meant to kick in from Jan 1st. Let's go to Bloomberg's car czar, Craig Trudell. Craig, I mean, it's remarkable. I mean, it's some of the last, maybe not the last vestiges, but vestiges of Brexit that are hanging around. What were the purposes of these tariffs in the first place? How did we get to this point?
Yeah, it came from the same, mindset that we're seeing, just in the last week, IRA sort of formalizing, these rules around what battery components and raw materials are going to be okay in order for EVs in the U.S. to be eligible for tax credits there. There was a real desire on the part of policymakers to, incentivize and actually sort of, require for EVs in the region to have local content in order for them to be traded back and forth. What it may have, sort of resulted in, perversely, is EVs being hit with tariffs that combustion cars would not be hit with. And of course, I think, policymakers on both sides of the channel would tell you that that is not a place where they want to be given the transition that we're trying to engineer here.
Yeah, I mean, awkward literally when COP is happening to,
yes.
to have that be the potential fallout. I mean, beyond that, but because of that, really, Craig, when we do have these duties come to fruition, assuming they do at some point, what will the fallout be?
I think, we may get to a point where this becomes much less of a concern, where we do have much more of a localized supply chain, but we're not there yet. And I think, there are some legitimate reasons for that. Even a company like Tesla that, has a local plant now in Europe just in the last couple of years, they push back plans to make batteries in Germany. This is, for sort of the obvious reason of the state of the industry, that you have a significant amount of battery production in China. You actually have more production than you have, demand for. Much lower costs there than you would be able to sort of, get costs down to in Germany. And, that sort of, state of affairs doesn't look like it's changing anytime soon. There is some real effort to get to that point, but it's going to take time. It's going to take investment. And so there is a sort of, real need on the part of the industry to relax some of these rules to allow for, us to get to that end goal.
Right. Well, we'll see if that 3-year delay happens. Craig, thank you so much for joining us. That is Bloomberg's car czar, Craig Trudell. All right, coming up, Amazon makes a move suggesting it's prepared to go to a price war with Chinese fast fashion startup Shein just on the eve, not the eve, but nearing their IPO. We're going to have the details on the e-commerce battle. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Amazon is sharply cutting fees for merchants selling cheap clothing. It's a sign it's hunkering down for a price war with Chinese fast fashion upstart Shein. Amazon says it's reducing seller fees on clothing products priced below $15. It's now going to be 5% for the fee. It used to be 17%. For more on this, let's bring in Charles Allen from Bloomberg Intelligence. Charles, if there's anything we know about Amazon, it's that it doesn't really like to reduce fees, these so-called referral fees for its charges on merchants. So put this into context for us. Is this really Amazon hunkering down, ready to go to battle with its fast fashion rivals?
Well, obviously it is to a degree, because there isn't really a proper fashion marketplace in North America at the moment. And so making sure that you establish one is quite important. And that is to make sure you have as many different brands and merchants on your site as possible. So if reducing the fee to get them on the site is a way to do it, then yes, it makes sense.
How is Shein? I mean, we've been talking about a Shein IPO. It's expected to be massive. How is Shein so successful with merchants and this low-cost clothing model? Because they're obviously not the first to do it, but they seem to really race ahead of many of their rivals.
Well, I mean, there are two different parts to Shein, obviously. The bit that we've heard most about is its own merchandise, that is sourced in a very rapid way, close to its operational headquarters in China, and then it's shipped directly from China to consumers throughout the world. And it's able to do that in a way that seems to mean that it avoids customs duties and local sales taxes as well. The marketplace, which is what we're talking about, is something that's been added on top relatively recently. And I think it's particularly in the US that we've seen the marketplace really come into be an important part of Shein.
Now, of course, I mean, as has been made clear by our discussion, Shein isn't the only fast fashion rival that Amazon is facing, but not the only rival with ties to China. How much pressure could Amazon be under, given all this, again, especially with the pressure of an IPO coming from Shein? And just less than a minute here, Charles.
Yeah, I mean, there's a couple of things. I mean, obviously, with an IPO coming up, Shein probably has to demonstrate some profitability. I mean, for Amazon, apparel is a big market where, although it has a very significant presence, it hasn't really managed to make it in the fashion-forward part of that segment. And so it's trying to get into that area as well.
Okay. Charles, thank you very much. That is Charles Allen from Bloomberg Intelligence. Amazon is up, slightly in the pre-market, probably nothing to write home about. It is up slightly, as is Apple today, I should say, still around that $3 trillion mark. All right, coming up, Vladimir Putin heads to the UAE and Saudi Arabia today. It's a rare trip, and we'll have the details for you next and what to expect on Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Stocks get a jolt. European stocks rise and U.S. futures point higher as a job slowdown in America boosts hopes of lower rates next year. Meanwhile, traders fully price in 150 basis points of ECB cuts next year. Vladimir Putin visits the UAE and Saudi Arabia today. We're going to discuss the agenda for the Russian president as he makes a rare trip abroad. Plus, CEOs from the biggest banks testify in Washington today before the Senate Banking Committee. Bank of America CEO Brian Moynihan says he sees the U.S. economy slowing, but still expects a soft landing. Good morning and welcome to The Pulse. I'm Danny Berger in London. Now, we are awaiting any news coming out of a trip from Russian President Vladimir Putin. It's a rare trip abroad. He's going to the UAE and Saudi Arabia today. Oil, that's very high on the agenda, and it's trade and negotiations between OPEC+. Joining us for more on this is Raktim Katake, who joins us now from Dubai. Raktim, again, OPEC+, obviously on the agenda. We just had their, perhaps confusing meeting last week. What exactly would Putin be hoping to get out of a discussion around that?
Well, I think, as we know, that oil is going to be quite high on his agenda when he meets with the Saudi Crown Prince MBS. The Saudi-Russia alliance within OPEC Plus remains very, very key. This is at a time when following the OPEC Plus meeting last week, despite a plan to cut production deeper, oil has declined every day since then. So it's a very important time for the market. The market will be looking very closely to what Putin and Saudi Arabia say.
What about geopolitics? Obviously these are countries that have, been put perhaps in awkward situations, not just for Ukraine, but what's happening in Gaza as well. What would be a desired outcome from Putin in terms of geopolitics?
Well, it's a very interesting time for him to be visiting this region. As we know, COP28 is on in the UAE. The world's eyes are on this region, and while Putin is here, oil will be discussed. So it remains to be seen on how he is going to on how COP and the oil market balance each other out. But definitely a very, very interesting time for him to be here.
Yeah, no, it certainly is. Not to mention, there was even some talk, does he go to COP? But that seems very unlikely. Hey, Raktim, thank you so much for this. That's Bloomberg's Raktim Katake. Now, Ukrainian President, speaking of which, Ukrainian President Vladimir Zelensky has canceled an address to the U.S. Senate. Negotiations are currently stalling there on $61 billion in new weaponry and other aid to his country. The White House has warned that the U.S. could run out of funding for Ukraine by the end of the calendar year. The package is being held up by Republican demands that a majority concession on immigration policy at the U.S.-Mexico border. Now, also one of the most read stories on the terminal this morning, U.S. President Joe Biden says he might not be running for a second term if Donald Trump wasn't seeking to return to the White House. Biden told donors at a campaign fundraiser that the former president poses a grave threat to American democracy. Now, those comments come amid reports that the campaign of one of Trump's major Republican rivals, Ron DeSantis, is in turmoil. Meanwhile, it seems that some of the more wealthy Republican Party are coalescing around Nikki Haley. Now, in company news, Rio Tinto has announced plans to spend more than $6 billion to develop a giant iron ore mine in Guinea. CEO Jakob Stausholm told us exclusively why they think the costly project is worthwhile.
It is, of course, expensive to build a new iron ore mine because you also have to build the infrastructure. But it is an iron ore of an exceptional quality, probably the highest quality on the planet, and only basically competes with the iron ore mined in northern Brazil. So it's the kind of ore for the future. Because a lot of the ore can go straight into a DIR, electric arc furnace process, and therefore you have much less CO2 emission. So it's attractive to get into our portfolio. It's a different quality than what we have in the Pilbara. And we also believe that there's space in the market for this new mine.
With market conditions as they are you confident about the levels of capex that would be required to continue investing in this project?
Oh, absolutely. No, it's a very good project, and it's well down the road. It's 25 years ago the ore was discovered, and we have recently developed it very well. I was traveling to Guinea just 4 weeks ago and went out with helicopters and saw the good progress we are having. So we are basically at a point of sanction, just subject to final approval by the authorities in China, our Chinese partners.
You do expect that China will hit peak steel consumption sometime soon. So this is not entirely a bet just on China?
No, well, there's a couple of things to say around that. First of all, the rest of the world is growing, and whereas China has been at what you call peak level of steel consumption, you can see that India is now coming up the curve, and they will need much more steel in the future as well. So in aggregate, the world will be growing. And don't forget, any mines, they are at some stage running out of iron ore, so you have to keep on investing in new replacement mines just to sustain the level of production. We are the world's largest producer of iron ore, and as you would also have seen, we have just announced today a study of developing the Rhodes Ridge. We need to develop more in the Pilbara, and we are developing Simandou.
Are you looking at other assets at this point?
Not in the iron ore area. We are trying to find a good balance between our leading business of iron ore and also being big in with the Western world's largest producer of aluminium, and we have a strongly growing copper portfolio. So it's a matter of finding a good balanced portfolio that fits the future.
Yeah. What is the future of China to you? Because obviously so much of that voracious appetite for iron ore, for steel, has been on the property market, which is in the process of being delivered.
Yes, look, it's always difficult to talk about an economy for the long term, but of course the track record of the Chinese economy is pretty impressive. And right now, I've just been traveling around in China. I'm quite optimistic in a way. The Chinese economy is growing. You're absolutely right. The property market has its challenges. But then again, China is spending more, again, on infrastructure. And there are certain industries that are booming. For example, the automotive industry, particularly the electrical vehicles, and that also helps demand.
Rio Tinto CEO Jakob Stausholm speaking exclusively to Bloomberg Daybreak Asia co-anchor Heidi Stroud-Watts. Now, Russia's income from oil exports is now greater than before the invasion of Ukraine. It's a failure of Western sanctions, and it's the subject of today's Big Take. Joining us now to discuss it is Bloomberg oil strategist Julian Lee. Julian, we've had this price cap policy trying to avoid this very exact thing that we're seeing that adds to Putin's war chest. How has it evolved since its original implementation that's perhaps allowed Russia to continue to see the money flow in?
I think what has changed, I think, is the fleet of vessels that's being used to move Russian oil and the companies that it's traded through. So over the course of this year and much of last year, we've seen the amassing of a vast fleet of tankers that are owned by shadowy companies that very little is known about. The people behind them are secretive. They're set up in jurisdictions that very often are far from Western eyes and Western control. And a growing proportion of Russia's crude is being shipped on those tankers. The price cap effectively said that Western ships, Western insurers, Western service providers couldn't be involved with trade in Russian crude if that crude was sold above $60 a barrel. Those kinds of restrictions don't apply to these shadow tankers because they're owned outside of the Western countries. They're not insured by the recognized insurance societies, and so that has helped the oil to move. The other thing that has happened is we've seen a small number of relatively new, unknown trading companies also set up in places far from the West who have, out of nowhere, started to control vast proportions of the trade in Russian crude.
So what could be the consequences of this? I mean, when you have numbers like this, the first thing you go to is, okay, do policymakers try to crack down on it? But is that even possible, Julian?
Well, I think there's a real difficulty here, and I think it's a tension that lies at the heart of this price cap policy. It was a policy that was introduced in order to keep Russian oil flowing. The European Union had proposed sanctions that, in addition to the bloc's own import ban, would prevent European ships and European-based insurance companies from providing any services for Russian oil whatsoever. The US administration in particular was very worried that would take something in excess of 3 million barrels of oil supply potentially off the market, and would send prices soaring. And there were plenty of forecasts around at the time that said oil would go well above $100 a barrel. So in that sense, the price cap has worked in that it's kept global oil prices lower. How you go forward from this is difficult because sanctions on tankers will hit volumes.
Yep, certainly. All right, Julian, thank you very much. That is Bloomberg oil strategist Julian Lee. Now, I want to bring you some data that just broke moments ago. It is UK construction output has dropped for a third month in an S&P survey, coming in at 54.5. The expectation had been a slight rebound. Construction companies also cut employment for the first time in 10 months. Input prices, meanwhile, declined at their fastest pace since 2009. So maybe easing inflation, but concerns about this British economy. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Welcome back to The Pulse. Apollo Global Management says it's getting harder for active investors to beat indexes in public markets. CEO Mark Rowan told Bloomberg exclusively that better returns, this might surprise you, can be found in private assets.
We've had a sea change, not just over a year, we've had it over 15 years. So much of our public markets are indexed and correlated. 80% of volume S&P 500, 60% of the market ETFs. 100% of our returns this year are from 10 stocks, which constitute 35% of the S&P, that traded an average PE of 50. How many of us come in every day looking to buy 50 PE stocks? Not many. And I guess what I'm suggesting to you is that public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
Is that not inherently a risk in your mind, liquidity?
Liquidity is a risk to everyone, but in differing degrees. So if you are a retirement plan or a retirement system, you know your liquidity requirements for the next 10 years. So if you can get paid for illiquidity, why not get paid for illiquidity? If you're a wealthy individual, how many of them need 100% of their money on Tuesday? If they don't, they should get paid for illiquidity. And we're seeing that in the performance data. If you look at the active management has failed to beat the index 85% of the time for 20 years. And I think it's going to get harder, not easier, to beat the index. As more and more of the market is indexed, very little money is left to actually make up what needs to be done in active management.
What is the single operational distinction between Drexel, Burnham, Lambert, and your Apollo? What is the micro idea you can give us of then versus now?
I'll give you Drexel, I'll give you Lehman Brothers, I'll give you Bear Stearns, I'll give you SVB, I'll give you First Republic. The financial institutions tend to die of one of two causes, heart attack or cancer. Heart attack is funding risk. They borrow short and they lend long. Cancer is the slow addition of poor quality assets, which over time undermine the system. So you look at all of those firms, all of those had an element of both heart attack and cancer, funding risk as well as asset risk. You look at what we're doing, we are borrowed long and lent long. Everything is matched. Everything is in a fund. There is no daily liquid, quarterly liquid money at Apollo. we are ideally situated to take advantage of less liquid assets. We've structured ourselves that way. And then you look at the totality of what we do. Equity is a risk business. Equities go up and down every day. You can lose money in public equity. You can lose money in private equity. In the credit business, the vast, vast majority of what we do is private investment grade.
When I look at the risks out there and to translate it into Nassim Taleb and all the work he did in quant with Black Swan, what are the tail risks you see right now for private equity? I mean, are you hedged perfectly? Is there next to no delta where you feel so comfortable? Or are there actual tail risks at Apollo?
I don't think there are tail risks, and I don't think there are tail risks in private equity. I think private equity is a risk-taking activity, but each of the companies, each of the situations is idiosyncratic onto itself. And over time, private equity has proven to be a very good asset class, recognizing that in certain markets you will lose money.
That was the Apollo CEO, Mark Rowan, speaking exclusively to Bloomberg's Tom Keene and Jonathan Farrow. All right, now we have some IATA lines coming across the terminal. This is, of course, the International Air Transport Association. They have doubled their airline industry profit target for 2023. They now see $23.3 billion. So it is a record revenue. With the pandemic in the past, that would be a record. But after that, it'll continue in 2024, but it will moderate. They say $964 billion is the revenue for 2024. And that compares to $896 billion for this year. Now, in the next hour, we are going to be joined by the IATA Director General, Willie Walsh, on these record-breaking figures. Now, coming up on the show and later today, bank CEOs are going to be on Capitol Hill. We're going to discuss what we can expect from Jamie Dimon and Jane Fraser. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The problem is that when you have a new idea, everybody wants to look at all the negative aspects of it, and it blocks you from building the first one. Once you build the first one and you see it's successful and people understand the value, then you can keep going. And so I think we view new ideas from a lens of why doesn't it make sense? Rather than saying, hey, this is a great idea, let's build a couple of them and then we'll figure out if there are negative impacts. Or we figure out how to make those negative impacts go away. We tend to paralyze ourselves, overthinking, always overthinking when a new idea has got an opportunity to have an impact. There's no time for that anymore. We need to really focus on outcomes and how do we reduce carbon. Every carbon we prevent from going into the atmosphere is a massive win right now.
Jennifer Holgren there, the CEO of carbon recycling company Lanza Tech, on her company's technology and the barriers to innovation. You can watch that full interview on Leaders with Blackwell Goes Green, 9:30 p.m. New York time tonight. And across Europe, you can catch it on Thursday, 6:30 p.m. London time. Now, first to pay attention for later today, the CEOs of big U.S. banks are heading to Capitol Hill today for the annual oversight hearing. They are expected to make their case for watering down rule proposals they argue will harm the economy. Let's go to Bloomberg's Jenny Surain for more. Jenny, what comes to mind is Jamie Dimon saying that, private capital is dancing on the street on new regulation. Is that kind of the vibe of what we're expecting to hear today?
Absolutely. I think that's going to be one of the main things we hear out of these CEOs is really trying to hammer home for the Senate committee that they think these rules will not only hinder them from making new loans, but they just think that they're misguided. So we're expecting a pretty strong opposition to what's coming.
Yeah, exactly. We can maybe expect some of it. It will still be interesting nonetheless to hear what they say. Elsewhere, Goldman, they're setting aside more for compensation. This isn't the first time we've heard this from Goldman. I know it was their asset management arm not that long ago. Is this just Goldman specific because they've had some of these image issues, or is this, hey, maybe bigger pay is coming back for the rest of Wall Street?
I think it's a little too soon to call it for the rest of Wall Street, because I think you're absolutely right. Goldman does have these sort of one-off issues. They've had a lot of employees, making these public snipes and complaining about the measly bonus payouts they got last year. So I think in some ways this might just be Goldman trying to kind of get on better footing on that front. The markets have just been so quiet in terms of M&A and deal advisory, so I don't think we're expecting a huge increase in bonus payouts.
Yeah, fair enough. You got to show up if you want that payout. Jenny, thank you so much. That is Bloomberg's Jenny Surain. And we will be covering that Senate testimony across TV and radio for you on your terminal. TLIV Go is where you want to head. And by the way, speaking of M&A needing to come back, we're going to be speaking with Citi's head of asset management, Citi's head of sponsors, Anthony Diamandakis, in the next hour in about 30 minutes time. So we'll talk about that outlook and, whether maybe bonuses are coming back. First, your check on Bitcoin and gold, though, as we head to the end of an hour. Bitcoin still trading above 43,000, just nearing 44,000. It is still the ETF hope, but I love how IG Australia, Tony Sycamore put it. Surely the ETF story is well and truly priced right now. Maybe this is just benefiting from that Fed pivot. Gold gets a little bit of a boost today after tumbling 3% in the past two sessions after hitting a record high. All right, you're not rid of me yet. I'm going to be back after the break with Manus Cranny for Bloomberg Brief.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The bond rally taking a pause after global rate cut bets boost sovereign bonds around the world. Markets now fully pricing 150 basis point cuts from the ECB in 2024. In big tech, Amazon slashes the fees for its merchants selling clothes targeting Chinese fast fashion seller Shein. And Apple marks $3 trillion in valuation. The Fed is back. That's according to Apollo's Jim Zeltner. We'll look at what that means for asset managers around the world today with Anthony Dimitakis. He joins us shortly. So we may be full bull on the Mag 7, we may be full bull on tech, but there's something much more malevolent, according to Danny Berger in the IB chat before I came on and said, you've got to look at the Russell 2000. There's the level of malevolence. It's down 33% from its November 21 high. What does that tell you? That is the precursor to pretty much a heck of a lot of the recessions that you've seen. But equities, in the meantime, there is some kind of self-fulfilling bull rage in these markets. There's a monster pivot in the rates market to rates cuts. That's the elixir of life. Stocks are higher this morning by 0.2%. However, be wary, be warned. Goldman Sachs are concerned that there no longer are there any burrs left out there. There's a frenzy. It was boosted by the job openings, the jolts yesterday, the lowest in 2 years. The prices paid, the lowest in 4 months. And so there is this sort of momentum in this market this morning. There's a turbocharging in Europe of 150 basis point cuts may come. 125 is what's locked in. There may even be 6. So keep an eye on the DAX. You've got the likes of Infineon on the up. You've also got that nice story coming through on tech and Apple from Foxconn improving their guidance. That gives Apple a $3 trillion valuation. Infineon and Porsche both driving the Xetra DAX higher. 150 basis points, as they say, is now priced in. Again, Asia getting a nice dovetail wind from all of the tech rally and this narrative in the bond market. Danny, good morning.
Good morning, Manis. Look, it's that 150 basis points of cuts that are priced in that is captivating the attention of this market. Bonds turned to sell from a rally yesterday. It was that JOLTS data falling below 8.8 million that allowed the bond market to fall below 4.2% for the 10-year. Now, we're going to have these markets for you now. Here we go. Manis, you know I had to put in Bitcoin just for you. We're just under 44,000. I love what IG Australia, Tony Sycamore over there said. He said, surely the ETF story is well and truly priced. Maybe not. We're still going higher. But he says that this is the asset class that is seeing the most juice from a Fed pivot and policy more than any other asset class. Now, the euro is moving higher versus the yen. And this I am truly bummed out about, Manis, because I had such a good stat for you. After we had poor manufacturing come in from the likes of Germany, we did see the euro fall as much as 0.2% versus the yen. And what I was going to say to you was that this was 8 days of euro weakening versus the yen, the longest losing streak since May 2018. But the markets have ruined it for me. But this is a clean way to kind of see what that pricing is, Manis. Now, on that, there is kind of this feeling that the market narrative has run away from the Fed and from the ECB. And Manis, to this point, I think we have Alarian, wow, I can't even speak, talking about this yesterday of losing control of that grasp.
Yeah, I mean, he's basically saying these bond markets are now taking hold of the narrative to such an extent that it doesn't matter what the central banks are saying, and that's when the narrative really loses all momentum. And of course, it was Schäuble yesterday in Europe who really delivered the game changer. And it's interesting, we had like 25 basis point cuts priced in, and now the market is lurching higher. So it's a question now of what level of pushback is there that's being brought to bear. But let's put this bond market rally in context. The bets are that maybe they'll take a pause. Investors are expecting the ECB to lead the pivot, fully pricing in 150 basis points of cuts in the coming months in 2024. Sam Munstead is tracking these markets for us. Sam, you know, is Mohammed El-Arian right? Are the markets, you know, is the risk here that the central banks lose the narrative, the Fed loses the narrative?
Well, I think, man, it's actually that the Fed has kind of already lost the narrative. You know, I think over the course of the last couple of months in particular, the markets have appeared to have pretty much decided that the central banks are done, that cuts are done. There was some caution in that, and you do see these kind of oscillations on a day-to-day basis. Like today, we're seeing a little bit of a pullback in bonds. But overall, what markets seem to be doing at the moment is that any data that comes through that backs up that there are going to be rate cuts, they jump on it. Any data that doesn't, they kind of try to find the parts of that data that do back it up. And then if it's really bad, maybe they'll pull back a little bit. But for the most part, it's all going in one direction.
Yeah, I mean, it's interesting because a lot of people just don't like the JOLTS jobs data, say it's unreliable, the response rate is really low. That kind of sets us up for an interesting Friday then, doesn't it?
It sets us up for an interesting week, right? Because so we've got the JOLTS data. You're right, like quite a lot of, you know, there's a mixed opinion, should we say, on JOLTS in terms of, you know, certainly market participants. But we've got loads of jobs data this week, you know, and there's so much to go into that US story over the course of the week. So as I was just sort of saying, those oscillations that you do see in those market bets, you might see that happen a little bit over the course of the week. But for the most part, the trend line remains that people see cuts coming, and they see them coming earlier and earlier next year.
It's interesting, we spent the day at Apollo yesterday with various heads of the institutional business there. And perhaps out of the block, 6 a.m., 24 hours ago, 23 hours ago, it was Jim Zeltner saying, look, this market, the bond market, the equity market, they're trading as if the Fed put is live. They've got a loaded gun, it's locked. You know, do you get that feeling that these markets are sort of overstretched? Is it fast money in these markets? This is what Danny and I were talking about, and we had Jupiter Asset Management, the CEO, in with us a couple of weeks ago, and he's saying he's not convinced. He thinks it's fast money, not real money in these markets. What do you reckon?
Yeah, I mean, I think that does ring true. You know, I think, so like I was saying, you know, the narrative has shifted really significantly, and markets do appear now like totally convinced that rate cuts are coming next year. Now, whether that's gone too far, too fast, you know, obviously we'll have to see. But I'm seeing more and more things land in my inbox particularly as you guys kind of say, from longer-term investors who are saying this feels like it's overdone, like it feels like it's gone a little bit too fast. And I think you're probably going to see that chorus continue. But, you know, overall, at the moment, if the data continues to be where people who are betting on cuts want it to be, then I don't think that story is going to change too much.
Sam, you didn't say anything to Manus about Manus. I think you just said that the quant's money wasn't real.
Ooh, no, I don't want a whole load of IBs on my Bloomberg terminal having a go at me. I didn't say that.
I was going to say,
go on.
The quants definitely have terminals, Manus. You know you're going to get some IBs after this.
You are brutal. No, listen, you know what? There is a difference between fast money. Well, let me put it to you this way. The meat-eating bond traders have got teeth. The quiche-eating commodity traders, you know it's a favorite phrase of mine. The quiche-eating commodity traders can be tricky. Let's just hope the equity traders can show their mettle. Let's just draw a line under their quant money, real money. Oh, she's off this morning, isn't it? It's going to be a tricky run for the next 55 minutes.
You dug yourself out of the hole, Manus. That was eloquent. Quiches and all. Hey, Sam, thank you very much for joining us. That is Sam Unstead. All right, let's turn to a different contour of this market, and it is tech. Amazon is slashing its fees for its merchant sellers of clothing that are priced below $20. That's as they're facing the rapid rise of the Chinese fashion brand Shein, which, not to mention, we're expecting an IPO in the coming months. For more, let's bring in Bloomberg Intelligence's Charles Allen. Charles, I mean, why is there, in the first place, this battle to be the leading fashion marketplace in North America? Because, I mean, you look here in the UK, for example, it's very well established. You have Boohoo, you have Shein. What's going on in the US?
Well, I think, you know, Amazon has been in clothing for a long time, but it hasn't really managed to get beyond the basics level. And you've got Shein coming in with a really fast fashion proposition that initially was all its own merchandise, but it's now spreading out to build out a marketplace as well. And I mean, if you think that consumers are going to think fashion, think Shein, rather than think, you know, clothing, think Amazon, then you've got this dilemma at the moment for Amazon is how can they make sure that they're actually in the more fashionable part of the market. And then you mentioned the potential Shein IPO. I mean, obviously, one thing in an IPO is you want to be able to show profitability and probably a path to more profitability. So, you know, maybe Amazon is looking at taking, you know, setting lower fees at a moment when it might be slightly more difficult for them to be matched.
I just want to know what you can get for $20 here in the United States of America. That's all I want to know. Charles, good morning to you. Charles doesn't deal in that $20 bid. Charles, tell me this. Why hasn't Amazon established this leading position? I mean, what is it called? It's called Whole Foods or Whole Paycheck. I'm an avid spender in there. But on the fashion side, why have they not got a dominant position?
I think one thing is that fashion is more difficult, is that, you know, remote selling for fashion always requires more photography. It involves, you know, more cost probably in setting it up. When you buy something, you don't just want to see a stock photograph of it, you want to be able to see the back of the item. And particularly as you move up in price. And I think that Amazon has, you know, it's been really, really good at moving loads of more commodity product, but when it gets to the sort of more discretionary items, it's maybe found it a bit more difficult.
If you look at the difference between Shein and Amazon, I mean, Amazon's been public for a while now. Shein, it wants to be public, according to reporting, in the coming year. Is this a reason perhaps Amazon has an advantage that Shein, I mean, they can't necessarily be cutting their margins, that they have to be thinking about profit right now?
Yeah, I mean, Shein clearly has to, I mean, the reports suggest that it is profitable, but, you know, at quite a low level, which would match what you see in the European online-only apparel companies, you know, where they've got single-digit margins, as opposed to, you know, say, Inditex, which has got mid to high teens margins. So Amazon obviously is also a low-margin business, but apparel is a relatively small part of its total, so it can probably afford to be a bit more aggressive in that area, whereas for Shein, it's all of its business, really.
You know what? This just made me realize, Manus, I finally found something I can afford to give you for Christmas. I'm going to find like a $15 hat to send you from Amazon.
You don't want to see the
How's that
beanie
sound?
that I've got with me this morning. I think it was from. Actually, I think it's from Uniqlo, and it's about $10. There you go. I'm a broad church.
Oh, yeah, that's pretty good. There you go. Hey, Charles, thank you so much for joining us. That's Charles Allen from Bloomberg Intelligence. All right, let's get to some of the other top stories that we are tracking on the terminal this morning. Germany factory orders unexpectedly fell 3.7% in October. It surprised analysts who did predict a slight gain, and how manufacturing in Europe's largest economy remains stuck in a rut.
Allianz Asset Management has quadrupled the amount of investments its Asia equities team can oversee, in part by increasing the hiring. The move is just the latest signal that the investors are turning to hedge funds that employ diverse strategies to weather the market turbulence.
General Motors is calling workers back to the office for at least 3 days a week. The shift ends CEO Mary Barra's work appropriately policy that gave people flexibility to stay home during the pandemic. Manus.
Coming up a little bit later in the show, we speak to Anthony Diamandakis, Global Head of Global Asset Managers over at Citi on Bloomberg this morning.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Now, President Putin has arrived in Abu Dhabi. We learned this just moments ago. It's a rare foreign trip that will include a visit to Saudi Arabia, a top priority, bolster cooperation among oil producers. Joining us now is Bloomberg's Alaric Nightingale, who also wrote a big take on how Russia has circumvented oil sanctions. It's really fantastic. But first, Alaric, Can we start with the state of OPEC Plus? We have Putin over in Saudi and the UAE. Where does the conversation stand? What more can perhaps be gleaned for a conversation between three of the OPEC Plus members?
Hi. So it's not just about oil, obviously. There are wider strategic interests, but oil is a central part of this, given that OPEC Plus last week agreed to make some deeper cuts to oil production. So Russia needs to try and kind of do its bit and make sure it stays disciplined. And also, I think it's viewed as a way of kind of corralling those countries outside of OPEC. So it's great for Putin to make this rare visit outside of Russia. It shows, he's starting to kind of become more settled, which will leave others uncomfortable. And he has to just, try and settle Russia's position within OPEC Plus.
Alara, good to see you this morning. Look, the world is going to be watching the theatre of Putin meeting Mohammed bin Zayed and Mohammed bin Salman. This is about theatre of being able to leave Russia, travel to friendly nations where a West warrant will not be implemented. But here's the question. He's riding $70, $80 oil. It hasn't collapsed. It's above the cap that the United States and the allies had set. What significance do we draw from his arrival in the UAE in terms of the effectiveness of the embargo and the caps that have been placed on oil on his nation?
I don't know that his arrival says much about the effectiveness of the caps. If you look at the price of Russian oil itself, actually it is closer to 60. It's there or thereabouts. There's always been a discount, and the discount has gone up and down. Lately, it's kind of edged a bit wider, so it's getting a bit cheaper, and it is actually around about the cap. So Russia does have its challenges, that's for sure. And the arrival in the Middle East is, as you say, it's theatre. It does sort of concrete his position in the world and just give him, an air of credibility. When, as you say, there are other countries that are, pressing and attacking, and this just gives him an air of credibility, I suppose.
Okay, well, we'll see what the news flow is over the next couple of days. That is Alaric Nightingale there on the arrival of President Putin in the United Arab Emirates. Danny, quick check on the oil market. With 4 days of where we saw a pretty big beating. Look, these are the currency boards. Let's just check in on that first of all for you. The dollar down again. The rates market is collapsing. Let's just have a look at the oil market, as I say, down for 4 days in a row. And in part, that dollar drop has not really supported the oil market. You're looking at oil down over the past 4 days. It's clawed a little bit back, but down nearly 6%. The message that Putin is going to send very squarely here, Danny, when he hits the ground in the UAE, is that we are one team, one dream. That is the OPEC Plus. This is him being able to go to his allies and really sort of, on the back of Novak yesterday saying that they can take additional steps.
Yeah, and again, it's about the theater. We were looking at the pictures earlier, so now we wait to see what sort of readouts will come from these meetings. We'll have that covered for you here on Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Manus Crenny in New York. Danny Berger alongside me in London. So as cable languishes, there are taxes even for mansions. I'm going to show you two beautiful properties. Not that I'm bidding on either of them. They're way out of my league. This is Rutland Gate in Knightsbridge. Of course, it's a beautiful property. And then there's another one, The Home, 40-mansion home in Regent's Park in Marylebone. Now, that's much more my style there now, Danny. The bay windows. Yeah. Are you Rutland Gate? I mean, the point of this...
on the water.
On the water. These are two of the most expensive homes and mansions in London, and they are struggling to sell. Price tag, £250 million for the home. That's that one there. And $200 million for Rutland Gate. Are you in the market, Danny Berger?
I'm trying to get out of the London market at this point, Manus. But yeah, the home, this beautiful one, beautiful. It was formerly owned by a Saudi royal family. It's in receivership now, following a lapse of a loan. Manus, I got to tell you, one of my favorite activities in London is to walk along, you know, that Kensington Garden neighborhood with those like huge mansion houses and some embassies. Literally, my favorite activity is to walk by it, walk past the guards, wave to them like I belong there, like it's one of my homes, and just, you know, imagine my life in the delusion that I live in, that one day I'll have one of those homes.
I'll give you a better delusion. When I was young, when I was a lot younger, I used to live in Cheney Place, which is a very salubrious address in London. However, I was living in the maids' quarters in the basement floor because the family upstairs had the rest of the house. So it was the younger days. It was opposite La Tonclair. Those were the halcyon days of Cheney Place, SW3, in the servants' quarters. We've come a long way.
I love that. Yeah, just don't mention the servants' quarters thing. You know, when you tell people about those beautiful days in Cheney Place. I love it, Manus. All right, coming up, we're going to be speaking to Anthony Diamandakis. He is the global head of asset managers at Citi as we discuss the rate environment and what that means for private capital going forward on Bloomberg Brief.
like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Bond rally takes a pause after global rate cuts bets that there's going to be a boost of sovereign bonds around the world. Markets now fully price in a 150 basis point cut from the ECB in 2024. In big tech, Amazon is slashing fees for its merchants selling clothes, targeting Chinese fast fashion seller Shein. And Apple marks $3 trillion in market cap. The Fed put is back, according to Apollo's Jim Zeltner. We'll look at what that means for asset management with Citi's Anthony Diamandakis in just a moment. First, though, before we get to that conversation, let me walk you through where we stand on markets. It was a day of a bond market rally yesterday. First, we had Schnabel talking as a dove, which is rare for her since she's more hawkish. And then we had the JOLTS data coming in below 8.8 million. That gave a boost to this bond market, but perhaps it is perfection priced in, and perhaps that's why we are coming back. Yields are higher by about 3 basis points, still under 4.2%. Bitcoin, that's decided to keep rallying. Over at IG Australia, Tony Sycamore said, okay, isn't the ETF priced in by this point? How can we keep going higher? But he says that this is really where we're seeing the most fuel being added around the rate cut bet. It's really benefiting Bitcoin, maybe more than most things. Meanwhile, the euro turns to gains versus the yen. Now, this is interesting that this pair has flipped. Earlier, it had been a weaker euro versus the yen because we heard the BOJ talking about ending negative rate policy, and we had some weak data from Europe. But Manus, perhaps this is just a sign that risk assets are in, so no one wants to go into havens like the yen this morning.
Well, that bond market rally has infected every cross-asset allocation, and this equity market feels as if there isn't a bird to be found. That's essentially what Goldman Sachs are saying. Now, the question is the debate. Jupiter Asset Management CEO was with us a couple of weeks ago. He said he thinks it's fast money, flighty money, perhaps not as serious as those meat-eating bond traders, but there is a propensity in this equity market that makes you feel that it's a frenzy. It's almost like a self-fulfilling bull rage. You've got that JOLTS number, as you say, the lowest in 2 years. A couple of big things are coming through. One is the rates narrative. Two is the tech narrative. Foxconn guiding higher gives Apple a $3 trillion valuation. And that's important because that whole tech narrative has lifted Infineon in the DAX. The DAX has made a record high this morning. The market's pricing in 150 basis points of cut. There is this velocity of this pivot both in the US and in Europe and in Asia that's lifting all of these boats this morning. Danny.
Well, look, we are seeing a Treasury rally that's decided to take a pause this morning, Manus. We had, as we've been talking about, a ramp up in Fed rate cut bets. And a lot of this is about the expectation for what Powell's next move is. Bloomberg spoke exclusively to Apollo's Jim Zeltner about the central bank's next move.
If there were any kind of challenging economic backdrop, the Fed does have a loaded gun that they can use as needed and as appropriate. I'm not assuming it's going to happen. I think you're going to see what we're all expecting. You know, we're students of history. We expect to happen in 08 to happen again.
Right.
I don't think you're going to see that happen right now.
So what does that mean for these markets? Joining us now is Anthony Diamandakis, Global Head of Global Asset Managers at Citi. Anthony, thanks so much for joining. Really great to see you this morning.
Nice to see you.
So the inverse of a Fed put is what we've had this year, and that did result in this icing over. I don't want to say completely frozen, but an icing over of the deals market. For that to thaw in 2024 and for the market to come back, how predicated is it on that gun being fired and getting rate cuts delivered in size?
Well, first of all, I'd like to say good morning and thank you to you and Manas for a great pronunciation of my very complicated last name.
We'll take it.
Which is great.
We're not always good at it, so trust me, it actually is a compliment. We practiced and got yours.
That was great. So what I'd say is that we expect next year to be a big deal year. So both in terms of size of deals, number of deals. The question is, when is it going to start? Why have we frozen up on deal activity today? It's largely because there's been a bid-ask spread disconnect between buyers and sellers. Why is that happening? Buyers still face some, cloudy sort of economic concerns for the end of 24. And sellers, frankly, don't need to sell, and they certainly don't need to sell at these asks. So I think that'll tighten up sometime into Q1 next year, and we'll see more activity.
Well, what is the trigger for that? Is it just enough time has passed? What happens in Q1 that the gap closes?
I think the clock's ticking both on the amount of dry powder that private equity groups and infrastructure funds have raised, as well as the return of capital, which sponsors need to do through exiting their portfolio companies. So as time moves on, and we've seen 18 months of this freeze, we expect that to thaw a bit.
Anthony, good morning to you. It's Madison in New York. You talk about dry powder. We're trying to contextualize the flow that can come in to this market next year. What is the size of the institutional dry powder? I know that on the retail side, there's $5 trillion in money market funds. So that can also seep its way into the system. But from an institutional point of view, what kind of gunpowder is there really to play?
Well, incredibly, we estimate there's $3 trillion worth of dry powder in private hands, and that's the private market, so private equity funds, infrastructure funds, sovereigns, pension funds, and that today is sitting on the sidelines. To offset that, we typically see, and this chart's a great example of it, we typically see something like $1 trillion worth of deal activity. That should be ticking up. It's gone the other way. And so, that gap that you see there in 2022, 2023 will be made up over the next 2 years. It's a fundamental factor, and that needs to happen.
That sounds pretty huge. Is that a record year? Does it have a corollary? Does it look like 2021? What is actually the scale of the explosion from this?
Well, we shall see, but there's certainly a record number of dry powder, record lows in terms of deal activities, and so the difference between the two should mean we would expect, at Citi, we're expecting 24 certainly to be the beginning, and 25 to be record deal years.
You've mentioned infrastructure funds twice, and obviously I know you have many areas that you look after, but is 2024 going to be a year in which we see, this was the year of tech-quoted equity behemoth. What is 2024 going to be characterized by? Is it going to be trophy hunting? Is it going to be LBOs? Is it going to be infrastructure in the US? What's going to define the flow, the mandates for you next year? Because you must know what some of them are.
I think, yeah, sure. In the first half of the year, I think we'd expect more defensive sectors, so we'd see more infrastructure fund activity. We'd see food, telecom, and other defensive sectors, healthcare. I think towards the second half of the year, as there's conviction in the market around the U.S. elections rates, I think we'd expect to see much more tech activity.
In activity in the here and now, we've had this recent rate rally, which has resulted in this pretty precipitous drop in funding costs. You look at yield to worst on the U.S. ag, it's at a 4-month low, something like 5.5%. What are you seeing from your clients? Is this kind of like a rare window of opportunity? Schroeder's described it as a frenzy of trying to get borrowing into the public market. Would you say it's a frenzy right now?
I'd say the leveraged finance market is healthy today and will go from strength to strength in 2024. That's largely largely because you open up the year. It's always January, February are always strong leveraged finance months, and so we'd expect both the CLO market and the loan market and the high yield market to be much stronger in 24 than today. But again, today leveraged finance is not the issue for financing buyouts. Things will get better next year, certainly, but I think some of the other fundamental factors around equity are the prime driver.
Anthony, January of this year, I sat down with Khaldun Al-Mubarak in Davos, who runs Mubadala, and the idea was that the sovereign wealth funds of the Middle East would be the liquidity providers in absentia of a tightening of financial conditions. We've gone through that. We've had a virtual easing. When you talk to the sovereign wealth funds, can you tell us, are they still massive trophy hunters, or are they liquidity providers? Are they shifting how they want to deploy capital from the Middle East to Singapore? Is there a differentiation?
It's really been an evolving story, Manus. I'd say, let's take the Middle East, for example. The Middle East, the groups in the Middle East with the most capital are continuing to mature in terms of their investment strategies, and that's Abu Dhabi, Saudi, and Qatar in particular. I'd say that's where we're spending the most time today in terms of expectations around capital, which will go outbound. And so those groups are gearing up. They see an attractive buying opportunity, and they can deploy in size because they're flush with liquidity. In Singapore and Canada, it's business as usual. They've always been very big backers of the private equity market and will continue to do so.
Are those days of trophy hunting over? That's what I'm trying to understand. What are they looking for? I mean, we had these moments, zeitgeist moments. You're laughing, but I mean, you know, they got their hands on Claridge's, on the Shard, on a whole host of other sort of real trophy moments. I mean, does the UK offer them bigger opportunities than everywhere else? We're talking about mansions that you can't offload in London.
Yeah.
So what
I think we'll still continue to see that. We'll see an element of that, certainly, and we've seen it certainly with sports clubs. And media franchises, so we'll see that. But I would, what we're seeing is that the Middle East has become incredibly. They're taking a very strategic view on equity deployment internationally. So I don't think it's just about trophy assets. I think you will see that, but I think you'll see some very strategic purchases.
You know, if we look forward from here, if the previous phase of alternative asset managers was this boom, more people cropping up because of low interest rates, is the next phase of this area consolidation? And if so, what exactly does that whittling down look like? How brutal could it get?
It's a great question, Danny. So we'll continue to see consolidation for two reasons. One is as private equity groups, as monoline private equity groups decided to expand and diversify by asset classes, one of the prime reasons was to gain liquidity, increase size and gain liquidity for the public markets, usually founder-driven or employee-driven. I think we'll also see that from a fundraising perspective. There's a synergy. I think a lot of the big LPs are looking for programs to be able to invest in across the alternative asset manager. And so to be able to offer more scale, a scalable opportunity to LPs, I think will become attractive and will be a driver for consolidation.
Anthony, we wish you well with the Flow Show for 2024. Come back and crack open some of those deals with us when you break them. That's Anthony Diamandakis of Citi, our guest this morning on the Flow Show for 2024. From New York and London, a very good morning.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
It is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. It's time now to talk about the global airline industry as it's set to generate record revenue this year, according to IATA. The latest report forecasts the industry net profit of $23 billion. That's more than double what the trade body expected just 6 months ago. Guy Johnson has helped them along on the way to profitability. He joins us now with the IATA Director General, Willie Walsh. Guy, getting the air miles in. Good morning.
Absolutely. Let's get some air miles in right now. Manus, thank you very much indeed. As you say, we're joined by the IATA Director General, Willie Walsh, joining us from Geneva, publishing the 2024 Outlook today. Willie, the industry has seen really strong demand recently. The top line is really good, and looks like that story is going to continue, maybe plateauing a little bit. The issue remains, though, that this is an industry that struggles with margins. The profitability is being affected by the costs that are hitting the industry, and its ability to drop that top line to the bottom line remains challenging. How does that change? What does this industry need to do to become more profitable?
Well, thanks, Guy. I think you've summarised it very well. If we look back to that period, 2010 to 2019, actually, we did make a shift then. I thought that was a period during which the industry exercised a lot more discipline around capital investment, real focus on return on capital. So we're still in recovery stage. I think this is probably the last time I'll talk about recovery, because we're effectively back to where we were in 2019. Always challenging with the general macroeconomic environment. The global geopolitical issues are impacting on the industry as well. But actually, we remain cautiously optimistic about 2024. And I think the recovery we've seen in 2023 has been very encouraging and should give the industry reason for optimism next year.
Does this feel like a recessionary environment, Willie? The world's trying to figure out what is happening, what's going on with the global economy. My line is always, if you want to know what's happening with the global economy, you ask an airline boss, because they see everything. They see fuel costs, they see consumer demand, they see freight, they see everything. What do you see?
Yeah, we see reasonable economic growth. Certainly in emerging markets, the growth is quite encouraging. Less so if you look at the Eurozone and maybe the US. So the traditional established markets will see lower growth. We're seeing a strong recovery in the Asia-Pacific region. They've still got a way to go to catch up to where they were in 2019. But obviously, inflation has impacted on everybody, more so on the airline industry because of fuel. It's about 30%, 31% of our cost base against the traditional maybe weighting 6-7%. So fuel has been a real drag in 2023, and it will impact us again in 2024. But, you know, the positives are employment levels remain quite strong, and that's pretty much the same wherever we go in the world. Demand remains quite good, although we've seen some regional impacts at an aggregate level. It's still looking pretty healthy for this year and for next year.
Willie, the industry is trying to consolidate. Certainly in the United States, we saw the Hawaiian-Alaskan announcement the other day. In Europe, it's happening as well. Regulators seem reticent, though, to allow some of this consolidation to take place. Do you think this consolidation is good? Do you think regulators should be maybe giving the green light to some of these deals? What's the message from IATA?
Yeah, personally, I've always been positive towards consolidation. I think it is part of the solution to the low levels of profitability in the industry. It's not the only solution. I think we need to do a better job ourselves, but consolidation certainly would help. The industry is very fragmented. Certainly in Europe, where I would describe the fragmentation as being much stronger than anywhere else. So good to see that airlines are still pursuing consolidation, because I think that is a positive development.
COP28 taking place in Dubai. We're all watching the headlines come out. Willie, is this industry in a strong enough financial position to deliver on the commitments that have been made with regard to decarbonisation? That process looks unbelievably expensive. And I hear what you're saying about the fact that the industry is profitable, but it's only just profitable. And I'm wondering whether or not there is the financial resource within the sector to deliver what has been promised without significantly raising airfares.
No, you've summarised it very well there again, Guy. Airfares have to go up. You know, there's just no way of avoiding that. You look at our net margins, 2.6% this year, 2.7%. People look at the top line and sometimes look at the, you know, the aggregate bottom line, 25, 26 billion next year, and think this is a highly profitable industry. Margins are wafer thin, and there's no way the industry can absorb the additional costs that are coming our way as we transition to net zero. So whatever way you look at this, consumers will have to pay more for their tickets as the costs of transitioning to net zero is reflected in the airline's cost base.
Final quick question. What do you see in China? You talked about Asia just a moment ago, but I'm curious as to whether or not you think that China is going to come back in a significant way. We've been anticipating it for a while. It hasn't delivered. We're waiting for it to happen. When does it happen?
I think it will happen in 2024. The domestic market in China, very, very strong. The international market is still lagging behind. A lot of that is down to the slow pace of recovery of US-China flights, which is certainly holding back the rate of recovery. But when we look at the general Asia-Pacific region and China in particular, we think that will come back strongly in 2024.
Willie, great to catch up. Thanks for sharing the 2024 outlook with us. Willie Walsh, the Director General over at IATA. Danny, back to you.
Guy, thank you so much. That was Guy Johnson with the IATA Director General. Willie Walsh warning us that there's no way to avoid higher airfares. Guy, I wish you had some better news for that. I'm trying to get out of here and go to the beach sometime soon.
I think we all are.
Fair enough. Guy,
I'm not.
thank you very
I'm
much.
working
Guy
very
Johnson
hard.
there. Manus.
Right.
Oh, yeah, of course. It's because Manus has
Manus.
the glory of the Christmas tree at 30 Rock.
Yeah, but Manus has had like 5 years in Dubai. He's seen the sunshine. He's got his quota up. His vitamin D levels are through the roof.
I've got 5 years of Emirates miles and still a couple of 100,000 left to spend. So anybody that wants to bid for them, please do.
I love it. I love it. Manus with the permanent tan. All right, Guy, thank you very much. Okay, let's get you your check on these markets. It is 10 a.m. here in London. We're looking at a gain of about 0.25% for U.S. equity market futures. The bond market rally turns into losses. We're higher by about 2.5 basis points. Are they just priced to perfection? Is it, Manus, as Alarian says, that the Fed is losing control of the narrative?
Yep, well, we'll see what kind of a grip they put on this racehorse that is this rally very shortly. Coming up in the show, we're going to take a look at what is going to set your agenda for the day. We're getting closer. I can smell the jobs report on Friday, and after jolts, it's getting frisky.
worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg. It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. We're going to get a Bank of Canada rate decision that hits at 10 a.m. Eastern. Bloomberg Economics expects the bank to hold rates amid a recent GDP miss. Then bank CEOs are going to be heading to Capitol Hill. U.S. major bank executives will testify in front of the Senate Banking Committee. That starts in the 9 a.m. hour. Then later today, we're going to have the fourth GOP debate. Ron DeSantis, Nikki Haley, Vivek Ramaswamy, and Chris Christie will all face off, while the former president is expected to skip again. We're also going to hear from the BOE Governor, Andrew Bailey, Manus. I think this one is interesting because they just released the Financial Stability Report. And in this, they flagged the concern of the huge buildup of short positions from the basis point trade and kind of the potential that has to shake financial stability.
This is the largest hedge funds have the largest trade position since 2020. And if you want to understand the size of the basis trade, Danny, we were just looking at some of the headlines. $800 billion from $650 billion in July. Now, I just wonder, this is the stability report. We have seen such a furious rally in the rates market is in part, some of that rally to do with an unwinding of this 800 gargantuan basis trade. It's got to play into it at some level.
Yeah. Well, it's kind of two things then, right? It's like, how sustainable is this if it is just positioning unwinding? And then the second part is if the BOE is right, is this just kind of a taste of what could happen if there's a larger unwind? They say it's a bigger risk than what happened in March 2020, Manus, when financial markets did seize up because of bond market actions.
Yeah, I mean, this is the accident that a lot of people, the left tail risk of accidents in bond markets that the memory forgets. From the brief to surveillance, good morning from New York.
Swinehart is supremely skilled at navigating the rapids of real estate.
That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Now is the time for the Fed to turn dovish, but they haven't turned dovish.
The fact of the matter is we had massive increase in interest rates that just haven't totally hit the economy yet.
Our view still is for a soft landing, and I think that's the challenge for equity assets in particular.
As much words we put out there about the soft versus hard landing debate, neither side has been the winner for investors all year.
The Fed does have a loaded gun that they can use as needed and as appropriate. I'm not assuming it's going to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 trying to bounce on the S&P positive. Equity futures up by 0.3%. We have had 2 days without gains on the S&P 500 for the first time since October. The bond market move continues. It's a break of 420 on a US 10-year. And we turn to the data, Bramo, ahead of payrolls on Friday.
Especially because we were saying maybe JOLTS wouldn't matter, the job openings data, and then it came in with the lowest number of job openings reported by companies going back 2 years. And all of a sudden, it mattered. It mattered quite a bit, and it sort of fed into this soft landing nirvana that we've been talking about. But with an edge of nervousness, with an edge of, is this just the beginning of a grind that erodes the labor market strength?
Can the growth inflation mix get any better than it is right now? We've just had Q3 north of 5% on GDP. Take the ISM, it's perfect. Soft landing crowd couldn't have made it up themselves any better. You look at the ISM, robust headline number, prices paid beneath the surface starts to come down. Throw in jobs, job openings, coming lower as well. Isn't that everything everyone wants right now?
It was the soft landing nirvana, to use Neil Dutta's words, that Chris Waller actually spoke about a couple of years ago, that maybe this is what would happen, and it appears to be happening. But here's the question. Given the fact that we saw manufacturing really tank, given the fact that there are some tea leaves that things are softening around the edges, is this just the beginning? Can you take a stamp in time and extrapolate out soft landing nirvana? That's the reason why you're seeing a bit of nervousness on the edges with the Russell 2000 in particular. And frankly, the NASDAQ actually recovering for the first time after a pretty rocky period yesterday.
Are you ready for the big game? The big game is ADP. Does it matter? Or doesn't it matter? ADP coming out a little bit later. 130 is the estimate. The previous number, 113. You know how this game works. It doesn't matter. It doesn't matter. Then it comes out. And if it's big, in either direction, it kind of matters for a moment.
Exactly. And today I was thinking a lot about this. I was thinking about ADP and does it matter? And I was thinking, what narrative could it feed where it would matter the most? And arguably, if it feeds the narrative that the JOLTS report yesterday was not a one-off and that you are seeing a more rapid deterioration of the labor market, that could fuel the fact that maybe the soft landing nirvana is just a moment in time and not something you can extrapolate out for months or even a year.
Economic data coming out in about 2 hours' time. Shortly after that, in the following hour, we're going to hear from the big banks on Wall Street in front of the Senate Banking Committee on Capitol Hill. Now, 2 big issues are going to come from this. I think the bank CEOs are going to want to talk about the following: transferring risk to private markets, we can talk about Apollo in just a moment, and compromising their ability to finance this economy. They are going to be 2 big issues a little bit later.
Basically saying we're going to have to raise our costs if you impose more regulations and more capital requirements for us. And you already see that in the prepared testimony, that this is going to be more expensive, consumers are going to pay this, and then you guys are going to scream, and this is going to be bad for the economy. But what I want to hear from them is really, where do they see us now? We heard this yesterday, some of the testimony or some of the discussion at the Goldman Sachs Financial Services Conference, talking about how there is this softening. Well, where? How significantly? How rapid? Is it a Walmart CEO type of softening, or is it a Jamie Dimon kind of softening where they still deliver record profits?
Jamie Dimon, JP Morgan, here's the quote: banks would be limited in their ability to deploy capital in the times when most needed, and the rule will have a harmful ripple effect on the economy, markets, businesses of all sizes, and American households as well, if these capital requirements go higher in the way that policymakers would like them to. So here's the question for me: is this about good policy or just about good politics? And for most people, they agree it's about the latter. It's not about the former. Cry me a river, get out the smallest violin possible, even if everything that Jamie Dimon and that crowd say today, even if it makes perfect sense, perfectly intuitive, we all sit here on Wall Street and we all understand what he's saying is right. That's correct. I don't think it matters, because this is about beating up the bankers going into the election next year.
I completely agree, and getting a soundbite. No one's actually looking to get a constructive discussion around capital requirements. On the flip side, how much are you going to hear questions around who exactly is getting loans from some of the biggest banks? Who exactly is taking out accounts? It usually is the wealthier individuals. The irony is there already has been the debanking that we spoke about yesterday at Apollo. There already has been a real transfer, particularly of consumer loans out of the smaller banks into some of these private investment firms. So at that point, who exactly is going to have to pay more or might not have as much access to capital?
It's a conversation that's going to dominate the morning here on Wall Street and in Washington, D.C., the nation's capital as well. Just to kick off the morning for you, good morning. Here are the scores. They look like this on the S&P 500, positive by 0.3%. Yields drifting a little bit higher, but still south of 420. We're up 3. Lisa, your 10-year, 419.34.
All right, ADP, we get that at 8:15 a.m. I am curious to see what the market reaction is more than even the numbers. We also get the Bank of Canada rate decision at 10 a.m. Curious to see what this means in terms of signaling where the balance of potential rate hikes could be. Today, as you were mentioning, John, we do hear from bank chief executives, including JP Morgan's Jamie Dimon, Goldman Sachs' David Solomon, Morgan Stanley's James Gorman, Citigroup's Jane Fraser, Brian Moynihan of Bank of America. Very curious to hear exactly what you're talking about. How do they shift this into an economic call, a warning sign of their role in some sort of nirvana soft landing? And then at 8 p.m., the 4th GOP debate is going to be taking place at the University of Alabama. Donald Trump is not going to be there. There are going to be 4 candidates. They're whittling them down. Very curious to see whether we can see consolidation around Nikki Haley, especially as calls for Chris Christie to drop out increase, especially as Ron DeSantis has had a lot of well-publicized challenges to some of his fundraising.
Odd comments from the president yesterday. You see those?
Yes.
He's only running because the former president is running, and maybe he wouldn't be if he wasn't.
2 things. Does this basically open a window if Donald Trump is not the Republican nominee?
Well, I think they tried to clean that up afterwards.
They tried to. It was ineffective. And basically, people are thinking, all right, on one hand, you can go back to the same kind of race. On the other hand, what if he isn't the presidential nominee?
AMH in the next hour with some thoughts on this one. Anne-Marie in Washington, D.C. That just around the corner. Let's kick off the market conversation with George Goncalves, the head of U.S. macro strategy at MUFG. George, we started the program talking about the growth inflation mix right now. Can it get any better than this? Never mind the soft landing, hard landing stuff in our future. What about right now?
Look, I mean, to be honest, like you want to put soft landing, hard landing behind us, but in reality, 2023 probably was a soft landing, aided by all this fiscal spending, and that has created this like kind of perfect environment. But you know, as Lisa mentioned, be careful about extrapolating. I mean, this could just be a moment in time sort of experience, and now it gets much more challenging going forward.
The market has come towards you. You've had this rate cut call for the month of March, I think for the best part of 4, 5, 6 months, George. Why are things materializing in this way? What did you predict that you're starting to see?
Look, I think it's a number of things. I mean, the bond market has been a skeptical bunch all throughout the year, and now it's kind of latching on to this idea that inflation's obviously heading lower, but the jobs market now is coming into question in terms of how resilient it really is. But it's really an insurance policy. I mean, the bond market is acting as if there's still downside risk. It's a more of a view on if something really were to break, both macro or markets, you have to be defensive in rates.
Is this a Fed put, George, essentially, that the Fed can cut rates, or is this simply just trimming around the margins to make it a restrictive policy in line with growth?
I'm not in that camp. I mean, this idea that the whole immaculate disinflation and this idea that the Fed's going to slowly kind of cut rates as inflation's heading lower. I mean, this is not what the bond market is pricing in for. They're pricing in for a slightly hard landing / something actually breaks in markets. So I think it's more about that than it is about lining up the Fed towards a kind of a soft landing.
You say that markets are pricing in something that looks more like a hard landing or something breaking. Are you talking about equity markets?
No, I think it's a combination of just financing availability, dollar liquidity, the banking system at large. I mean, bank lending has really stalled here at this point. It's a critical part of the economy, as you guys were referred to in the open. And I think that banks play a critical role. And if banks are sidelined, I mean, I think it's going to starve the economy for credit, and it's going to expose the weaker hands over the course of the first 6 months of next year.
George, let's talk about the data this morning. Never mind next year. 130 is the estimate on ADP. Previous number 113. The main event, that's the appetizer. The main event is on Friday. The big one, the payrolls report. The estimate at the moment can shift around, but at the moment, the median estimate in our survey, 187. Do you see downside risk going into these prints, George? And if so, why?
Look, a lot of the job creation lately has come from the government sector, so I think the ADP would have to be well beyond 130 to start to meet that number of 187. So I think ADP does play a critical role later at 8:15. But I think Joel's yesterday really kind of stole a lot of the kind of concern about the jobs market. If we're if we see like a close to 100 or sub 100 on NFP again, which is within scope based on a lot of other sort of like underlying metrics that we track, I do think that there is downside risk for Friday.
So let's just put a bow on this, because essentially we're talking about a new narrative creation, that maybe we're not in soft landing nirvana, but we're in the moment of time where you're starting to see the deterioration of a labor market that could lead to something more nefarious. Are you saying right now that there's nervousness around that kind of reality, and any kind of lower than expected jobs numbers will fuel that and create a bad news is bad news kind of narrative? You might see a rally into bonds, but you also will see stocks sell off.
Exactly. I mean, up until this point, that 425, 475 move in 10-year rates was supported for risk assets. I mean, if we get, we're under 420, I mean, as you guys have been noting all throughout the morning, if we get a move towards 4%, I think that's when the alarm bells really go off. And I think that's when other asset classes realize that rates are rallying because of concerns about growth and the jobs market.
Do you think that that's enough, that basically that's the narrative that's going to stick? Do you think that that's valid, or do you think that at a certain point rate cuts will help support this feeling that we won't go too far down, which is basically the whole argument of Apollo, that the Fed has a loaded gun? They've raised rates enough that they can drop them sufficiently to support whatever economic downturn we end up getting.
As we all know, these things operate with huge lags in both directions. And so by the time the Fed actually starts cutting, I mean, the reason why we've had March is because they have to start sooner. You have to kind of foam the runway, get the economy into a soft landing mode. The fiscal kind of supported that and kind of pushed back the Fed being the main actor. And so if the Fed doesn't start cutting in March, I mean, I think that you're going to have a harder landing. So it really comes down to this idea that it's not just the restrictiveness, it's really like what you're trying to engineer a more sustainable kind of recovery, because we're really at this fork in the road, right? Because if it's like this whole soft landing doesn't last forever, the next move should be acceleration and growth. How do you accelerate with 5.5% Fed funds? You can't.
This analogy, soft landing, we've got to foam the runway. Now, George, you're killing me. We've got to foam the runway, Bramo, into next year.
Well, it is an airline morning, given the fact that we got airline projections.
I saw that.
Honestly, I kind of can lean into it. Let's get punny.
That doesn't scream hard landing, looking at those airline profits, does it?
Exactly. That's what I was thinking. You've got record profits.
Phenomenal.
That are just sort of outweighing anything anyone expected. I mean, really, how do you pair that with this idea of everybody heading toward Armageddon?
It's difficult. George, great to catch up. George Goncalves there of MUFG, the original March rate cut call, I would say, over at MUFG. Everyone seems to be in that boat right now. Let's talk about one currency pair. Here it is, the obvious one, the euro against the US dollar. For all this rate cut talk, recession in America, etc., etc., why is the euro back to 107? Because the rate cuts we've priced in America we've just started to aggressively price in Europe as well. There was this interview with Isabel Schnabel of the ECB, Lisa, with Reuters. Remarkable, quite remarkable to see inflation come this low. A very pleasant surprise. It just sounds like the hawks on both the ECB and the Federal Reserve are just backing away and backing away.
So let's talk about some of the Fed funds futures. We can see a 55% chance of a rate cut by March by the Federal Reserve, an 86% chance of a rate cut by the ECB by March at this point. So talking about just how much people are pricing in. 150 basis points of rate cuts by the ECB currently priced into the market through 2024. It is getting aggressive. The deterioration is marked, but it seems like nobody is worried about inflation. It's that boogeyman is out the door.
Yeah.
And suddenly, you know, that's really the question to me. Is it? Are people just sort of leaning in because it feels good?
It's not about who goes first. It's about how deep, how far they go after they start. 175 is the call from Deutsche Bank for the Federal Reserve for next year. Binky chatter at Deutsche Bank on the equity side. This is the equity side, the conversation we'll have in the next hour. Is it 5,100 on the S&P over at DB for year-end next year?
He's been right, though. He came on here and was bullish, and we all were really skeptical. What about that recession that we were supposed to get in 2023? And he was bullish. I mean, people are coalescing around him, not the other way around.
The Binky chatter at Deutsche Bank coming up 7 a.m. Eastern Time. The big bull on Wall Street looking for 5,100 on the S&P year-end next year. Futures right now positive 0.2% on the S&P 500. Yields climbing a little bit higher by 3 basis points, 419.53 on a 10-year. Live from New York City this morning. Good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I expect all civilized leaders, governments, nations to speak up against this atrocity. Stand with us, stand with Israel, stand with civilization.
Benjamin Netanyahu there, the Israel Prime Minister, speaking yesterday as the war approaches the 2-month mark. I'm pleased to say that joining us now is Elliot Ackerman, the US Marine Corps veteran and former White House fellow. Elliot, wonderful to hear from you, sir. Always appreciate your perspective and your deep experience. Let's start with that experience. Can you describe for our audience the type of urban combat taking place right now?
You know, the urban combat that we're seeing in Gaza, you know, it's something that happens really at very close quarters, you know, street by street, house by house, room to room. As I think I've said on this show, even in an urban fight is like, it's like being in a knife fight in a phone booth. So it also takes away the advantage that high-tech militaries have. And I think we're seeing that play out. And it's also oftentimes it's very, very messy. And one of the greatest casualties in an urban fight is the city that the fight is taking place in. I think we're seeing that today as, vast parts of Gaza are being turned to rubble.
And the civilians who live there, Elliot, so let's discuss that. Given the type of combat that we're seeing at the moment, how on earth do you prevent the tragic loss of civilian life we've seen?
It's extremely difficult, and that factors into the calculus on both sides. Fundamental to Hamas's attack on October 7th was they knew that they were going to force the Israelis' hands to fight them inside Gaza, which would lead to civilian casualties, which would lead to much more attention being placed on the Palestinian cause in the world, and also a significant international outcry to end the fighting. And so, I think the one thing that we can see when we're looking at what is going on in Gaza is that at least thus far, it would seem that it has proceeded exactly according to Hamas's plan.
Given that, Elliot, how much longer do you think that Israel has from a political perception standpoint, as well as just their own aims, before they're going to stop?
The aims of the Israeli government, as they've articulated, is the complete annihilation of Hamas. I think one of the things that's difficult is it's an extremely high bar to completely destroy a terrorist organization, as opposed to degrade its capabilities or make it so it's no longer a threat. So if that is their stated objective, I think they're in some ways probably setting themselves up for failure, because it's difficult to see how they're going to completely destroy every single member of Hamas from the face of the earth, particularly as many of them are not in Gaza. And the other issue that complicates factors that we can't forget about is there's a significant number of hostages still inside Gaza. So the Israelis can't finish this operation until those hostages have been freed. So unfortunately, I think this is going to go on quite a bit longer, but every day that it extends, it becomes politically much more costly for the Israelis.
Do you agree with Secretary of Defense Lloyd Austin when he basically said that the fear here is that Israel is setting itself up for a strategic defeat?
I think that is certainly, I don't know that they are going to end up in a strategic defeat, but I think if the Israelis lose sight of the fact that war is always fought on two planes, both the tactical, the operational, what's happening on the ground, how much of Gaza is being taken or retaken, but also the political, how those actions are perceived. And so, history is littered with cases of nations and armies that won the battle but lost the war. And I think the Israelis need to be very mindful that they don't place themselves in that situation.
Elliot, we've been through a period of really intense diplomacy. We've seen that over the last 2 months. How elevated still do you think the odds are of a broader conflict in the region?
I think they've certainly lessened, but I think we absolutely want to keep our eye on any actions that seem as though they could spread the conflict. As you know, the United States has a very significant military presence there. We've surged naval assets into the Mediterranean Sea, all signaling very strongly to the Iranians not to spread this conflict or engage in those actions. But we've also seen simultaneously that the Iranians have been attacking U.S. forces abroad, that there have been many instances of provocation, and not only our leaders, but also our troops on the ground have to be very, very mindful that their actions could have strategic consequences. So I don't think it does not seem as though the conflict is going to spread, but it's still on a hair trigger.
This is a conversation about a direct conflict. I just wonder, from your perspective and your opinion, Elliot, whether you think we're already in a proxy war with Iran.
I think we certainly are, but we've been in a proxy war with Iran for decades now. And it has just waxed and waned. I'm a veteran of the wars in Iraq and Afghanistan, and both those conflicts, we were fighting a proxy war with Iran, and in both those conflicts, as an American service member, I was, having to dodge IEDs built by Iran and having to deal with Quds Force paramilitaries who were Iranian in those theaters. So we've been fighting that war for a long, long time, but it's very important that, as you noted, it doesn't escalate into an all-out conflagration across the Middle East, particularly as we have another war going on in Ukraine. So these are dangerous times we're living in.
I'm glad you brought that up. As a former American service member, as someone who's actually served and seen the threat, what is your sense of this increasing isolationism or the increasing fight over funding for some of these conflicts? Do you think that it's a valid one, or do you think that that's really a retracement from the role that you served for?
Yes, I think that there should always be robust debate in this country about issues of war and peace, and I think that is very, very healthy. However, I also think that those debates should occur in a functional as opposed to a dysfunctional way. They should occur in a way that has very clear-eyed or takes a very clear-eyed view of the world beyond our shores and isn't naive of the place of America in the world. So, I don't think it's inappropriate for members of Congress to be debating how long and how much the United States is going to spend on these wars. But I also think if there's some type of idea that the U.S. can just retreat within its borders, and that's going to be in the best interest of this country. I mean, we've seen that. We've seen that play out before, and it doesn't play out to the best interest of the United States.
You're implying, Elliot, that the debate right now is not healthy. What would a healthy debate look like, and why is what we're seeing right now not healthy?
I think there's a degree of brinksmanship that's going on. And I think that brinksmanship of, tying aid packages together, much of the dysfunction that we've seen in Congress where where Congress no longer exists with a culture, and I'm old enough to remember this culture, in which most people operated under a mode of that, America's differences ended at our shores, and when we projected ourselves abroad, we projected ourselves as a unified country. I mean, now we know that our allies, have different, they prefer a Republican or a Democratic administration and have policies that they set for both. So I think just the overall fractiousness in our country is hurting the efficacy of our foreign policy. So that's what I mean.
Elliot, thank you, sir, for your clarity. Elliot Ackerman there on the latest on the situation in the Middle East and with Ukraine and Russia as well. At least the United States now in 2 proxy wars, with Russia one and now with Iran in a much bigger way in the last few months.
Arguably, as Elliot was saying, the Iran proxy war has been happening for over a long period of time. The question is, and to his point, how much is there a unified approach from the United States versus some sort of tribalistic view of politics? And this really goes back to the conversation we were having yesterday about this question of healthy debate, healthy disagreement, ability to have someone disagree with you and not shout them down, understand what they're saying, try to process it, and then debate intellectually rather than emotionally, versus an all-out tribal warfare, which is essentially what it ends up being.
I think Elliot nailed it there at the end. There is always going to be healthy debate. Some division in Washington, you expect it. I do believe it's healthy. But on big issues, I think you want some bipartisan continuity. And on 2 big fronts right now, we don't have that. And to his point, I think you know what you're going to get if you have a Republican White House, which war is going to be supported. And at the moment, you kind of know where this is going on the Democratic side as well, which war is going to be supported. That doesn't say much for the people who are fighting those wars on the ground in these places.
Absolutely, especially if it's being held up by brinksmanship over other unrelated issues, rather than, I'm thinking about border control, which is something that people feel pretty passionate about, but that's really going to ultimately determine whether or not we get funding for completely unrelated conflicts because of people's wish to cater to certain political factions. Again, this concept of how do you present yourself as a unified country internationally at a time where the fractiousness is so great that it's tearing people apart, even within their own parties. It is a very frustrating situation.
It's so great, public and obvious to the world, for everyone, basically down in Washington at the moment. We'll continue this conversation. Let's turn to the markets. Tons of economic data coming up through the week. The ADP report a little bit later. Always the appetizer for the big one on Friday. The payrolls report just a few days away. Equity futures positive here by 0.2% on the S&P 500. On the market, Liz Ann Saunders of Charles Schwab. That conversation coming up very shortly from New York City. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Here's the price action this morning. The scores look like this on the S&P 500. We are just about positive, up by 0.2%. On the NASDAQ, up by 0.2 as well. Despite the fact we had a down day yesterday, to Lisa's point a little bit earlier, Lisa, tech did okay. Tech did okay beneath the surface.
And this goes to the whole question of if you get rate cuts, then essentially tech is still going to be the biggest and the best thing out there because of the cash. So they're going to win either way. You get a huge boom and they win because of the adoption in corporate spending. You get a softness and they benefit because at least a rate cut will support the valuation.
For the S&P 500, the first time for 2 days that we haven't had gains going back to, I think, October. Let's turn to the bond market. Here are the moves for you. 420 on a 10-year. We break that level. Even with a 3 basis point move higher, we're still below it. 419.72. Think about 450 on a 2-year. That level has held since June, I believe, going back to June. At the moment, about 461.58, up 4 basis points on the day, just drifting into the 450s over the last few weeks. I want to turn to foreign exchange, because even with those moves in the bond market, you've got to think about the other side of the trade, Europe. This is the 6th consecutive day of euro weakness. The euro against the dollar negative for 6 days, longest streak going back to July, 107.85. A key policymaker, someone who I follow really carefully, I think Isabel Schnabel is one of the best communicators on the Governing Council of the European Central Bank, Lisa. In an interview with Reuters, as we talked about a little bit earlier, surprised by how quickly inflation is coming down.
And basically just saying, doesn't seem like there's any need to hike rates further. In other words, they're done. Now the question is, when do they cut? Basically, when anyone signals they're done, everyone just extrapolates out immediately until how many rate cuts does that mean? And that seems to be where we are this morning.
A different growth backdrop, though, for Europe, right, compared to the United States. We're coming off the back of a quarter with 5% plus GDP growth. Europe, certain countries talking about recession over the last 12 months.
Which is the reason why perhaps people are pricing in 150 basis points of rate cuts at the ECB through all of next year. That's actually consensus. That said, did you see that DAX hit a record high?
At the close yesterday, yeah.
So try to pair this idea of recession with a record high DAX in Germany. I mean, I'm trying to understand markets versus the economy, and I don't think there's ever been a wider gap between the two.
If you told me at the start of the year, and I could do this on many things, that China was going to disappoint, I'm not sure I'd have the DAX up by something like 18%.
Exactly, thank you.
Yeah.
I mean, just trying to get the market call right off the back of the economic call has been fool's errand.
Forget it. It's always so tough. Never said easy money's been made. I say it all the time. It's never easy. It's never easy.
I know, that's how we all
It looks easy with hindsight all the time, but it's never easy. Let's get you some top stories. Under surveillance this morning, Israel vowing to push on with their campaign against Hamas amid mounting pressure for another pause in the war. Israel saying it would only consider another short-term ceasefire if it brought the release of more hostages. Prime Minister Benjamin Netanyahu saying Israel will, quote, fight until the end, Lisa, until a crushing victory is won.
And so here comes the question in terms of how much longer they have for the U.S. to continue continue supporting this effort. And there was one story that I was reading, I believe the New York Times, basically saying that Joe Biden's team has called them up and said, essentially, wrap it up by January so I can get my election campaign started. You know, there is a feeling that this is going to be really harmful if it keeps going for Joe Biden, and that might poke some holes in his support of Israel.
Let's talk about the president. Some surprising words from President Biden yesterday suggesting he may not have run for re-election if Donald Trump wasn't seeking to return to the White House. Biden speaking at a campaign event saying, quote, "If Trump wasn't running, I'm not sure I'd be running." The president then playing down the remarks a little bit later, adding he wouldn't drop out if Trump does. The comments coming ahead of tonight's GOP debate, Trump not among the four candidates taking the stage in Alabama. Clean up on aisle 2024, I guess, for the President of the United States.
So this was the cleanup act, okay? Somebody, a reporter at the White House, asked him if he'd be running if Trump was not. He said, I expect so, but look, he is running, and I have to run. It's sort of pointing to this need to save the country from Donald Trump, but it really does raise a question. Is he getting a lot more pressure to justify why he is running? I mean, why is he even raising this issue to once again make this a polar fight against the former President Trump at a time when both of the individuals are not very popular?
This is more of a question for Anne-Marie than it is for us, so maybe we can talk about this in the next hour. If he still believes he's the only guy in this party that can take down the former president in a head-to-head in an election, why have we not seen more outreach to the people that voted for the former president in the last election? Why have we barely seen any of that whatsoever? Why refer to them as ultra MAGA? I think Jamie Dimon sitting down with Andrew Ross Sorkin just in the last week talked about that's unhelpful. Of course it's unhelpful.
Well, and you take that a step further. There's one, why is there not outreach to people who he categorizes as ultra MAGA, but why is there not more outreach to people in the middle? Why is there increasing catering to different fringe parties in his rhetoric and also in policies? I mean, think about what they're dealing with right now with border control and some of his hesitation to back certain measures because of concerns about angering certain constituents. Again, there isn't the same kind of sense of what is his ideological driver apart from where the wind is blowing at different corners.
Wanted to unite the country and then use completely different rhetoric once you got into the seat. I mean, we'll talk to Anne-Marie about it in the next hour.
He's not alone, though. We hear this a lot.
I agree. Let's talk about the latest in Washington, D.C. On Capitol Hill a little bit later. CEOs of Wall Street's biggest banks hitting Capitol Hill this morning for their annual testimony before the Senate Banking Committee. In prepared testimony, JP Morgan CEO Jamie Dimon warning of tighter capital requirements leading to higher costs for customers, writing this rule will make services so uneconomical, you will likely see two outcomes. Many banks will simply stop offering certain products and services, and those that do will have to charge more for them just to make it worth the surface. You're going to see two warnings a little bit later. That and the risk, of course, being transferred to private markets.
That's where I was going to go. Notice the change in rhetoric. It's not debanking, it's kumbaya, we're all in agreement. This is from private investment firms. And then you hear the heads of banks saying, they're eating our lunch.
They're like, no, that's what it is.
Yeah, exactly, 100%. And you're enabling this, and we're going to go out of business, and we're a primary function. I don't think anyone's that worried about the biggest banks in the U.S. I think it's really a question of the smaller banks. And that's actually some of the CEOs and the presidents that might be more relevant, but less politically advantageous for sound bites.
I think opening testimony start when, 9:30?
I believe
About
so.
3 hours from now or so. We'll provide some coverage of that for you a little bit later on Bloomberg TV and Bloomberg Radio. I've been looking forward to this conversation. Liz Ann Saunders, the Chief Investment Strategist at Charles Schwab, joins us right now. Liz Ann, I've been looking forward to it because we're not going to talk about soft landing, hard landing, no landing, none of that. We're going to talk about what you and the team have been focused on now for a while, and that's rolling recessions. That is a framework, Liz Ann. Why is that so important for you, that nuance?
Well, first of all, this is a unique cycle. That's the ultimate understatement. I think taking a nuanced approach is important. And we've been using that term for quite some time. I think the only other person that I know that's been using it as long as we have is Ed Yardeni. And not that we want to rehash the last 3.5 years, but if you think about the stimulus-fueled demand surge coming out of the worst part of the pandemic, all of that demand and money associated with it was funneled into the goods side of the economy because we had no access to services. That was where the inflation problem first began, on the goods side of the economy, exacerbated by the supply chain disruptions. But fast forward to the more recent period, we've gone into hard landings, recessions for housing, manufacturing, a lot of housing related, many of the consumer product areas that were big beneficiaries of the lockdown. And we've gone from inflation to disinflation to deflation in many of the goods categories. We've just had the later offsetting strength on the services side. Same thing has rolled through in terms of inflation. So to me, best case scenario is not really soft landing. That ship already sailed for many important segments of the economy. It's a continued roll through where if and when services in the labor market get hit, you have found stability and maybe even some improvement in those areas that have already taken their hit.
Lizanne, love your nuance. Let's build on that. Where are you seeing opportunities that might have hit bottom that you want to be investing in now? In particular sectors that you think already have rolled through their hard landing and are now buys?
I still think that investors are better off taking a factor-based approach as opposed to a monolithic sector-based approach. But we have made some adjustments in terms of the factors that we're focused on. As you know, we've talked about it on this program. We have been emphasizing stay up in quality with factors like interest coverage and strong return on equity and strong balance sheet, but also growthy factors like positive earnings revisions and surprises. But I think you want to now add kind of a valuation kicker into the mix because this year was characterized by all multiple expansion, no earnings growth. We see in the last month that there is money itching to move out of the Magnificent Seven to find opportunities down the cap spectrum. And you have seen some lower quality kind of characteristics to some of what has rallied. I think you want to fade that and continue to lean into quality, but you can find it across the spectrum of sectors and also outside that group of just the Magnificent Seven.
So you said something, Lizanne, talking about how people are itching to take the money that they've put into the Magnificent Seven and put it to work elsewhere that might be at a lower valuation. How big is that wave of people itching to get out of the Magnificent Seven? Is this something that could cause an underperformance, or is it just simply there's just been so much money, people are looking for other ideas?
Well, so far, so good in terms of the rotational nature of this easing of some of the excesses. You know, you've seen some pullback in the Magnificent Seven, the Russell 2000, S&P equal weight is outperforming the S&P over the past month or so. It's happened in kind of a stealth way. That's obviously the best way to go through a corrective phase of excesses versus the bottom falling out all at once. What concerns me, particularly once we get past the year-end seasonality, is that there is an incredible amount of overlap, especially in the large institutional world and the hedge fund world, in terms of ownership of not just the Magnificent Seven, but up the cap spectrum. And that, you know, if we get some sort of catalyst and it unleashes more frenzy around selling, I think maybe the hit would have to be larger. But I do think, absent that, we could continue to see a broadening out via rotation, again, as opposed to some significant crack occurring in the market.
Lizanne, can you help us gauge sentiment just a little bit? We're told, Lisa and myself, repeatedly, that the money in money market funds is really, really sticky. As you look across clients and the people you speak to daily, have they been moving into equities over the last month? What was that move in November?
So you've seen some move in equities, but it's actually, interestingly, within the U.S. equity market, been toward areas like real estate, utilities. And I think that is in keeping with expectations of sooner rather than later Fed cuts. I'm skeptical about that, but that's where the money has gone. But sentiment is really interesting because attitudinal sentiment measures have gone off the charts of bullishness and, you know, very little bearishness. Yet even the AAII survey that we get those attitudinal bullish bearish readings, the equity exposure of that same cohort of investors has actually been coming down. On the other hand, active institutional managers have actually been significantly increasing exposure. So much like cross currents in the economy, there's even a lot of cross currents in terms of sentiment data, and it's really a mixed picture. And sentiment is it's always hard to use as some market timing tool, even at extremes, but it's particularly murky in this environment right now.
Lizanne, just to put a bow on it, you did just mention there that you're skeptical about rate cuts. Can you just explain that a little bit more?
Well, the inflation is still above the Fed's target. The labor market is hanging in there. The economy is hanging in there. How that justifies a pivot from the most aggressive tightening cycle to easing as soon as the first quarter of next year, I don't get it. It's possible the Fed could be easing, but probably because there's more economic dislocation between now and then. In addition, you had the Fed and Powell specifically pointing to the bond market doing a lot of the tightening for the Fed when you were in the surge in yields up to 5%. To me, what would be interesting to hear is if they start to to say, well, the loosening, which was a record 1-month loosening in financial conditions in November, maybe that does some of the loosening for the Fed. And it wouldn't surprise me if Powell has to yet again reinforce the notion that they're not, at this point, considering rate cuts.
That's the conversation for a week today. Lizanne, thank you. Lizanne Saunders there at Charles Schwab, one of the very best. Rolling recessions as a framework instead of this soft landing, hard landing stuff. It's a week away, Lisa. It's a big question. We've been talking about it. The Federal Reserve has responded to these easing financial conditions asymmetrically. We saw much more of an endorsement the other way around.
Basically, that's the reason why people now are looking at some sort of asymmetric cuts next year. Wei Li of BlackRock talking to you yesterday after she put out her outlook.
Yeah, she's not buying it.
She's not buying it. She's
Rates
along
high,
with,
volatility sticking around.
Yeah, basically, she thinks that people have gotten a little too optimistic. We see the risks of these hopes being disappointed. Did you see what Goldman Sachs' Scott Rubner said?
What did they say?
There are no longer any bears left.
Yeah.
And basically said, you know, things are getting a little bit nervous. You know, come on.
It's felt like that around this table.
Get a little more skeptical. No nirvana.
I'm with you. Coming up shortly, Ian Shepperton of Pantheon Macroeconomics looking ahead to payrolls Friday. Futures positive on the S&P, up by 0.2% from New York. This is Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
The number of job openings has been coming down. The work week has been coming down. Wages for job switchers relative to job stayers has been converging. In other words, you no longer have as much bargaining power if you change jobs. Combined with the number of people who are changing jobs for permanent reasons has also been changing. So the conclusion is we still have more and more evidence pointing in the direction of the labor market softening.
Actual conversation that took place in the last 60 seconds or so. Ian Shepperton sits around a table here in New York. Lisa, where are you based? Ian, sunny Newcastle. Bramo, quote, are they the team with referee uniforms?
Well, it's true. They all look like refs running around the field.
Well, they might look like basketball refs, but soccer refs don't wear stripes.
Ian, I'm so sorry.
I don't know where to begin.
I've spent years training TK. I don't know what's just happened.
All right, let's move on then.
What has just happened? That was Torsten Slov, by the way, of Apollo. Let's tee up payrolls. Counting you down to Friday. Wall Street's biggest banks out with their estimates. JP Morgan coming in at the low end, forecasting a gain of 150,000 jobs. Goldman at the top of the pack, looking for a print of 238,000. Ian Shepperton of Pantheon Macroeconomics expecting an even bigger increase of 275,000. Let's talk about all of this with the match official himself, Ian Shepperton. Ian, good to see you. I'm so sorry.
Should have brought my whistle.
Let's talk about payrolls. What are you looking for on Friday?
I've got a big number for a couple of reasons. I mean, I follow the home-based data, this real-time data set that we get from small businesses. That's unambiguously strong. It's not always right. It did a good job in September when we had quite a big print. It did a good job in October. So November, well, it's back to the upside. The trend is noisy. But we've also got a post-strike rebound from the UAW and the Hollywood strikes. And probably we'll get a decent contribution from government again, which is still rehiring after COVID. So I've got 50,000 from that source alone. So net, a decent print, but it doesn't really change the trend, which is just gradually decaying.
275 doesn't scream rate cuts, though.
It doesn't.
How does that work?
Well, because what's going on in the labour market right now is that the payroll numbers aren't really the whole story. Usually they are. But right now we've got an unemployment rate creeping higher, even though we're still getting decent payroll numbers, because the labour force is expanding very rapidly, mostly because of a big rebound in immigration. And what that means is that loosening is happening at a sort of a wage pressure level, even though payroll growth is still pretty strong. So wage growth is barreling downwards. The quits rate is back to its 2019 level. So all of that massive premium you got for job hopping in 21-22, that's all gone. And that's really what the Fed cares about. It's not payrolls per se that the Fed cares about. It is the extent to which the labor market as a whole exerts inflation or disinflation pressure. And right now, despite big payroll numbers, it's disinflation pressure.
So soft landing nirvana.
I hate saying that, but yeah.
I mean, that's essentially, I mean, this is basically the recipe.
It is.
The perfect kind of soup that a lot of Fed officials were talking about. So, you know, mission accomplished. Should they put a big banner up and sit there at the Fed meeting next week?
Well, I think they should, but they won't. I think they're going to hang on, gripping with their fingertips until they can't hold on any longer to the idea that, yeah, we still have optionality to raise rates, because let's face it, that whole transitory thing was a disaster for them, and they've really engaged in this sort of reputation rebuilding exercise to prove to markets that they can get it right this time. So they're going to hold on to that optionality just in case. I mean, what if you know, payroll is 325 Friday and then it's 325 again for December? Then suddenly all this talk about massive rate cuts will evaporate, and they want to be able to say, see, we told you.
I want to get into the actual data, but when you say reputational risk, that does bring up something quite significant, which is they're saying we have the option to raise rates. Everyone's saying, no, you don't. Give me a break. No one believes them. Haven't they already lost that reputational oomph to really jawbone the market?
Yeah, they have, but this is a story about rebuilding their reputation from what went wrong in 21-22. And I think at this point in the cycle, they don't much care if markets don't really believe them anymore. They just want to retain that optionality just in case. I'm pretty sure that Powell himself doesn't expect to be raising rates again. Maybe one or two of his colleagues do, but I'm pretty sure he doesn't. I think most of the governors are of the same mind. But it's a question of, you know, just in case, because the last thing they want to do is have to come back in January or March and say, you know, look, everything's gone wrong again, and we had just declared victory. So hold on, even though markets aren't listening anymore, and I think markets are right, but this is a whole consequence of the disaster of transitory.
Just in, Deutsche Bank, here's the call. Earlier, faster, further, bolder. This is the call on the ECB. I'll start with what they called for only the other week. Just last week, they downgraded Eurozone growth and raised the volume of ECB cuts in 2024 to 100 basis points from 75 basis points previously. Here's the call now. We are bringing the first cut to April, see a significant risk of a cut in March, and now expect the ECB to cut 150 basis points in 2024 versus the 100 basis points previously, with 50 basis point cuts back-to-back in April and June. Now, Ian, isn't that basically what's priced at the moment for the ECB next year?
It is, but it still looks pretty aggressive to me. I mean, I have no problem with the idea that European growth is weak. You know, the retail picture is horrendous, and you know, we've got modest declines in GDP for a couple of quarters. But yeah, that is quite aggressive. This is an institution which historically tends to move more slowly than the Fed, later and slower. But we're in a new world. We're in a world where disinflation pressure, I think, is rebuilding rapidly pretty much everywhere. And it's reasonable to expect inflation to come in way below the ECB's forecast, as it has done recently anyway. And a bit like the Fed as well. You know, the Fed next week is going to have to admit that they were half a point too high as recently as June in their forecast for inflation this year, and they're far too high again for next year. So I think a theme for central banks, ECB, Bank of England, Fed, most of the major central banks, the theme is going to be inflation coming in lower than we expected. Partly because I think Although labour markets have loosened, all the other stuff has been important as well. The improvement in supply chains, the slowdown in margin increases, the normalisation in housing inflation, all of these things are adding disinflation pressure that central banks maybe thought could happen but were reluctant to make their base case.
Language matters. When they cut, are they easing or going back to what they think neutral is?
There's going to be a lot of talk about how they're responding to the disinflation pressure and maintaining still a restrictive stance in the US anyway, and that, as Wallace said last week or before, coming down, bringing rates down because inflation has come down in order to maintain a reasonable real rate. They've explicitly recognized that as inflation drops, real rates go higher, and this is an economy that doesn't need to see a further squeeze from real rates.
Why do you think inflation is coming down so much? There's been a lot of disagreement that it can continue, that it is linear, particularly from Citigroup, where they're saying there are certain things year over year that could accelerate once more at the beginning of next year. Why do you push back so much against that?
There's always things that could go wrong. I could point to a couple of components of the PCE, like healthcare, that I'm nervous about to the upside. But fundamentally, what we've got is slowing wage growth, slowing rent growth, flat margins after rising 20% during the pandemic, complete repair of supply chains. We've got a labour market that looks much more recognisably normal now, and we've got oil at $73, $74 a barrel, which a lot of people didn't expect a few months ago. We've got falling global food prices year over year. So it's broad spectrum. Usually the labour market tells you everything, but this time around that's not capturing the whole story. There's so many other things which went so badly wrong in 21, 22, which have either fully reversed or are well on the way to fully reversing, and that's giving us this kind of broad array of disinflation pressure pretty much everywhere.
You said it, and I'm on board with you. The big change in the last couple of months has been what hasn't happened off the back of really robust growth. The fact that we had a third quarter of 5% plus GDP growth and didn't have an acceleration in inflation. In fact, we had the opposite. And Neil Dutta sat in your chair more recently and just said repeatedly, this labour market is no longer a reason for this Fed to be hawkish. That's a massive change, Ian, in the last 12 months.
Yeah, enormous. I mean, you go back a year or so, we had an outsized burst of wage inflation. It got to 6% in late 21, early 22, terrified the Fed, because if the next stop had been 7% or 8%, you'd be looking at the 1970s all over again, and there was a real horror that that was a risk. But already, even at the time that we were seeing those crazy wage numbers, we were seeing the quits rate start to come down, and the premium for job switching was beginning to say, hang on a minute, this isn't what's going to happen. We're not going back to the 70s. And here we are now, wage inflation is 4% and falling, and I think by next spring it'll be more like 3.25%, 3.5%. And if you're at the Fed with those sort of wage numbers, you've got nothing to fear.
I've got a treat for you, just to make sure you come back and see us again. Can we get this online? The majesty of a Newcastle strip.
You're just proving my
Just look
point.
at that. Just look at that.
Wait, they're called strip? Strips?
Strip. It's not a uniform. It's a strip.
It's not a jersey.
It's not a jersey?
No.
It's a shirt.
It's...
Catch up, Brown.
All I can say is anyone looking at that totally agrees with me. They look like refs. But thank
The
you.
Geordies of Newcastle are so deeply offended, trying to make it up to them. Ian, thank you, buddy. It's good to see you. Ian Shepperson of Pantheon Macroeconomics. I'm going to kind of get what you're talking about. I understand.
Thank you. I appreciate that.
Okay, they look like they work at Foot Locker.
Thank
Is that
you.
what you're trying to
Exactly.
say? Okay.
They're exactly.
Imagine what
Foot
Alan
Locker
Shearer would be
uniforms.
saying about this if he was tuning in this morning.
I daren't begin to imagine.
Deeply offended. Deeply offended. Ian, thank you. Stocks right now positive 0.2% on the S&P 500. Coming up very shortly, Binky Chadha of Deutsche Bank on his bullish 2024 S&P 500 target. One of the biggest bulls on the street joining this program up next. From New York, stocks just about positive. In the bond market, yields a little bit higher. No drama this morning. Good morning to you all.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Whether you realize it or not, your music taste is already partly dictated by artificial intelligence. But what if I told you some of the music itself was made with AI? Would it change how much you enjoyed it? It's worth thinking about because it's happening. sometimes illegitimately, as well as legitimately. Grimes, for instance, lets people use an AI version of her voice to fabricate new songs and split the royalties 50-50. Purists look down on artifice within artistry, but are AI-generated vocals any less creative than organic voice run through auto-tune or layers of effects? Because trust me, most pop is processed in some form, even if the singer can hit the right notes. More interesting, I think, is the idea of training AI on the work of the dead in order to keep releasing their music for the living. Again, this is already happening. Hundreds of thousands of fans have listened to the late Linkin Park singer Chester Bennington, that is an AI version of him, singing along to popular tracks from bands like Coldplay, and also to some songs by good bands. I think we should be careful. What's great about music is the circle of life. Influential artists create a body of work, inspire the next generation, then pass the torch on. We're going to unpack some of these questions and help you figure out what's next.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now is the time for the Fed to turn dovish, but they haven't turned dovish.
The fact of the matter is we had massive increase in interest rates that just haven't totally hit the economy yet.
Our view still is for a soft landing, and I think that's the challenge for equity assets in particular.
As much words we put out there about the soft versus hard landing debate, neither side has been the winner for investors all year.
The Fed does have a loaded gun that they can use as needed and as appropriate. I'm not assuming it's going to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Oh, you've missed so much already. A fantastic start to the day. Lisa deeply offending our guests. They may not come back. More of that still to come.
Fabulous.
From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P just about positive by 0.2%. The march to payrolls Friday continues. Lisa, the ADP report, about an hour away.
If it confirms the weakness that we saw yesterday in the JOLTS report, does that start to accelerate some of the rally in the bond market? And maybe even more interestingly, does it accelerate some of the softness that we saw in the S&P yesterday? In other words, are rate cuts no longer unequivocally good news for risk assets?
Got to get to these rate cut calls. More than 100 basis points price for next year for the Federal Reserve. The ECB something like 150. 150. Deutsche Bank coming out and endorsing that view. Earlier, faster, further, bolder. We could have a move as soon as March from the ECB next year.
That sounds like a pop song. Earlier, faster, bolder,
Do you want
stronger.
Deutsche Bank to sing it for you? Binky Charter coming up.
He'll sing it for us.
Singing the ECB call over at Deutsche Bank in just a moment.
Right now, we've got an 86% chance of an ECB rate cut come March. So when you talk about earlier, faster, bolder, stronger, whatever you want to have this pop song, there is this point that's already getting priced into the market, 150 basis points of rate cuts, not just the call. That's what's currently priced. So that raises this question, are people getting over their skis, or is disinflation so significant that it's going to surprise everybody? And then that leads to what? Either a soft landing nirvana, or does it lead to actual weakness in some of the earnings?
So market prices is leading, right? And it's being validated in some sense in Europe by the incoming information, a surprise to the downside on inflation, and encouraged also by the central bankers themselves. This started last week with Governor Waller. It's continued on the other side of the Atlantic in the last 24 hours with the ECB's Isabel Schnabel.
And she came out and she said she's been surprised by just how much disinflation there actually has been. And she said this, it has made further rate increase rather unlikely. And that is all people needed to do, to go to the races and say, all right, let's see, how early can they cut? Right? I mean, this is sort of the difficulty. We're talking about 3 phases. Neil Kashkari was talking about 3 phases of Fed policy, of central bank policy. First, hiking rates, then pausing, and then cutting rates. The pause was supposed to be a long time, and the long time ended up being, what, 3 months?
Well, it started in July, right?
Okay, right. But is the pause already over? Are we already at the end of that mid-cycle?
Marcus says yes.
Exactly.
But I'm with you. I think you need to see some deterioration of the economic data. And we haven't seen that in the labour market. Now, this is where things start to get interesting, because you can draw the conclusion that what you've seen so far over the last few months is basically the labour market's still okay, but disinflationary trends have continued. So maybe the labour market isn't what it used to be 12 months ago, where you'd see a print at 250,000, get scared about inflation running away from you, and you'd lean into a more hawkish rhetoric. I think they're more comfortable with these prints from the labour market now.
So I might have scared Ian Shepherdson away, and he may never come back, but he said something really important, so I do hope he does come back, which is that there's been an increase in immigration. There have been more people going into the workforce. This is exactly what some Fed officials were hoping for, to lead to lower wage growth, but not necessarily lower hiring, right? That you're still getting an ability to get a job, but you're not going to get the same kind of raise. It's not an extraordinary environment. People can quit any job that they can get and get another one. And that's exactly the kind of normalization that this Fed was hoping for.
And Mike McKee a week today is going to be grilling Chairman Powell. A little bit later this morning, the big bankers on Wall Street facing a grilling of their own from the Senate Banking Committee in Washington, D.C., so look out for that a little bit later. We'll pay some attention to that. I think it's worthy of attention at about 9:30 Eastern Time. Let's turn to the price action. The scores look like this on the S&P 500, positive by about 0.2% higher on the S&P. Yields drifting a little bit higher by 3 basis points on a 10-year lease of 419.34.
Does the ADP report matter?
No, and then it does.
Exactly.
And that seems to be how things work on ADP day.
So 8:15 a.m., it is ADP day. ADP employment report, we'll talk about whether it matters, and we'll find out. Bank of Canada rate session at 10 a.m. Curious to see whether the unemployment rate does tick up as we get the employment report on Friday. Today, as John was mentioning, bank CEOs head to Washington, D.C. to fuel all sorts of campaign advertisements that will be rolled out subsequently. Those that we're going to be hearing from, J.P. Morgan's Jamie Dimon, Goldman Sachs' David Solomon, James Gorman of Morgan Stanley, Citigroup's Jane Fraser, Brian Moynihan of Bank of America. They are going to say that we are going to have to charge our customers more. You are hurting our function as a bank. And then you're going to have all these people saying, Wall Street versus Main Street, why have you gotten record profits? And then it'll all get packaged together into sound bites that we will get to listen to for a very long time after that.
Yeah, it's frustrating, isn't it? Well, it's not about a proper hearing about policy. It's about politics. And to your point, clipping little videos to send out to your constituents. Did you see what I did today? I beat up the bankers ahead of the election next year.
My problem is there's some very real debates about some of the transition of certain lending functionality to different places around smaller banks and some of the questions about their viability. And then there's a question of the increasing selectiveness of some of the bigger banks and what that does. We can get into all of that, but point is, none of that's actually going to be discussed. 8 p.m., fourth GOP debate is taking place at the University of Alabama. Key question, are we going to get any candidate in the Republican Party who can challenge the former Donald Trump? That will be the entire subject, essentially, the subtext of tonight's debate.
AMH, 10 minutes away on that debate. Looking forward to that conversation. With us now, one of the biggest bulls on Wall Street, Binky Chowdhury, Chief Global Strategist and Head of Asset Allocation at Deutsche Bank. Binky, good morning.
Good morning.
5,100 on the S&P. Got to pair it with some rate cut calls. Talked about the ECB and Deutsche Bank, 150 next year. I think it's 175 from your team on the Federal Reserve next year. Can you help me understand, reconcile those two calls, 175 and 5,100? How does it all work?
So I'm not assuming any rate cuts. I would argue that, the risk to the market pricing of the rate cuts is, one of basically disappointment because really growth has been fine. We've actually been growing above trend rates 5-6 quarters now. So we're going to reward an economy that's growing above trend with a little bit more stimulus because we have this concern that real rates get too high. The house call for rate cuts is based on a slowing in growth. And so I would argue, if you look at Fed history, they haven't really moved, beyond sort of minor fine-tuning of 25 basis points this way or that way outside of clear recessionary signs. I mean, they've done it, we count 3 times outside of recessions historically, and each of those times was preceded by sort of a 10-point drop in the ISM. So what we're talking about, the House view is for a relatively mild recession. Now, you could make the case that, you know, inflation basically is coming down. It's coming down hard and fast. And I would go further and say, you know, if you think about inflation, you know, as being driven by fundamentals like unemployment and other things that happen basically from time to time, all of a lot of the inflation that we saw came from other things that are basically idiosyncratic to the pandemic boom and then bust. And so at the peak, the other component was contributing 3.5 percentage points to core PCE inflation. It has fallen like a rock over the last 6 months. It is down to about 1 percentage point. You will notice that we're not talking about fundamentals of unemployment. I'm talking all about the other part, which went up and came down, and that's, you know, what you were also talking about with the previous guest, which is the supply chains, the speed of the recovery, the synchronization of the recovery, et cetera, et cetera. So there's still room for inflation to keep coming down without any need for really growth to slow.
We've been talking about how you can get the economic call right, but you can still get the market call wrong.
Yeah.
If we get, you know, what you're talking about, does it matter, right? Can you just say, put the economic call aside and just say people have more money, they're going to invest it, they're going to invest it in stocks, so you can just bet stocks are going to keep going up?
Yeah, no, I think that the economic call matters, and it matters a lot because it is the macro growth that is going to drive earnings. Now, it's not only the U.S., it's also Europe, China, and Japan that matter for the S&P 500. But yeah, and you know, as you know, and I think I've said before, earnings tell a very different story from the consensus macro view that a very sharp slowing in growth is right around the corner, because earnings fell in the second half of last year. We've been growing very strongly this year, is the way I would put it. 3 quarters in a row of sequential growth. The market hasn't given a lot of weight to that because the market tends to focus on year and year and the like. But I would say if earnings have 0 growth in the 4th quarter, so go perfectly sideways, that's not my call, but if they do, earnings will be up year on year in the 4th quarter, reported in the middle of January by 11.5%. So that's something to keep in mind.
How much is this driven, though, by a number of very big companies versus some of the smaller companies that have struggled with margin compression and have struggled to compete, right? I mean, it sort of goes to Liz Ann Saunders' nuance of the rolling recessions and very different fates for different sectors.
Yeah, I'd characterize it just a little bit differently. I'd say we are sort of now in the phase, we did have rolling recessions. We are now in the, that was 2022. I'd say 2023 is more about rolling recoveries. And as to your question about growth and is it all just coming from a small group of companies, no, it's very broad-based, I would say. Outside of energy, materials, and healthcare, year-on-year growth's going to be positive and strong by the 4th quarter is what the numbers say. Now, a lot of that's coming from the base effect. We tend to emphasize sequential growth quarter-over-quarter, so that, and that's the way that we look at all macro data, so that's comparable. But if you do one year-on-year and the other quarter-on-quarter, you're sort of not really comparing exactly the same thing, is the way I would say it.
I'm sure, Lisa, if Liz Ann was still with us, she'd be bringing up the service sector as the shoe that hasn't dropped. The labour market that hasn't weakened materially just yet. We've seen a rebalancing, but is that weakness in our future?
Especially because if you take a look at just restaurant traffic, it has come in quite significantly. And if anyone's gone to a restaurant and paid, you know, $80 for 2 eggs, you can.
Here we go. Love this. Keep going. It's Bramo story time. It's always personal, Blinky. At least it continues.
Come on, all right. But you know, there has been a drop off in traffic for restaurants, and so you know, does that feed into the service sector? I'm not going to keep going.
No, just that you spent $80 on 2 eggs.
No, but I was thinking of your breakfast experience.
You've been going to TK's restaurants?
No, absolutely not. No, but to feed a family with children, especially teen boys, it becomes, you know, $200 evening out for just a basic meal.
It's expensive, I'm with you. In New York.
But like this
I'd like
is for
to hear more about
dumplings.
this $200 basic meal, though.
No, but
If you are just joining
dumplings.
us, welcome. On the S&P 500, positive by 0.1%. The conversation with Lisa on these $200
All right,
basic meals will continue.
Let me,
Can I get to Binky? I'd like a sector call. Is that okay?
Yeah, please.
Thank you. Binky, let's talk about banks just briefly.
Sure.
They're going to get a grilling on Capitol Hill a little bit later. Can you give me your call on that sector and whether it needs higher yields or lower yields, or whether that's relevant at all?
So, you know, the two parts of the S&P 500 that we are long, basically, and have been for a little while, is really the banks and the cyclical parts of the consumer. Logic simply being that if you sort of take a look at all the industries in the S&P 500, how much do they typically fall in a recession? Where are they today relative to their prior peaks in this cycle? And you will see that basically at the bottom, where there is most priced in really for a recession, is the cyclical parts of the consumer and the banks. And it's also telling you how the market has positioned itself. Those are the favorite underweights. Those are the shorts. And I would argue, you know, we've had positive growth surprises for a year. I would argue that, you know, the bar for growth to surprise remains very, very low, simply because the consensus continues to look for a very sharp slowing. As long as that doesn't happen, and especially if we don't go into a recession, that's the parts of the markets from a fundamental point of view that have already got a lot priced in. And of course, if a recession happens, they've already got a lot priced in. So I would argue that's where you want to be long. A lot of people have obvious difficulties with that review and the read. But if you do the same exercise, then ask yourself, last December, 1 year ago, what was sitting at the bottom is mega cap growth in tech. And where is it sitting now? So, and it seemed just as unpalatable.
Binky Charter, thank you. Binky Charter at Deutsche Bank. This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
At Penn, does calling for the genocide of Jews violate Penn's rules or code of conduct? Yes or no?
If the speech turns into conduct, it can be harassment, yes.
So the answer is yes.
It is a context-dependent decision, Congresswoman.
It's a context-dependent decision. That's your testimony today. Calling for the genocide of Jews is depending upon the context. That is not bullying or harassment. This is the easiest question to answer yes, Ms. McGill.
Just absolutely stunning. The exchange between Congresswoman Elise Stefanik and the University of Pennsylvania President Liz McGill during a hearing on anti-Semitism on college campuses. The Apollo CEO, Mark Rowan, has called for McGill's resignation, saying the issue goes beyond just anti-Semitism.
Say what you will, say what you want, allow the other side to speak. That is a culture of free speech. A culture where you shout people down, where you have 95% of the professor or academia speaking in one way, where you permit violent protests, where students aren't able to go to class because there's boycotts or there's pressure or other things, is not a culture of free speech.
Mark Rowan of Apollo joining us now. Bloomberg's Anne-Marie, AMH down in Washington, D.C. Anne-Marie, I have to say, for me, for many people watching that play out yesterday, it wasn't just stunning, it was shocking. Why are they unable to answer such simple, basic questions?
Well, it's very uncomfortable for those university presidents and also those watching. I mean, John, let me just tell you what Claudine Gay had to say. She was the Harvard president who was also one of the individuals that had a number of heated exchanges with Congresswoman Elise Stefanik, especially since Ms. Stefanik had gone to Harvard. She says, we do not sanction individuals for their political views or their speech, but when that speech crosses into conduct that violates our behavior-based policy, bullying, harassment, and intimidation, we take action. So you see these university presidents really trying to walk a line of making sure that they remain places of free speech, but obviously they don't want to see bullying and harassment. Now, Jonathan, you and I both know they have gotten such fierce criticism from donors that are saying that they have not come out aggressive enough ahead of all of this to make sure that it could be a safe space for all students, and also at the same time be able to make sure they are upholding free speech.
And Maria, I got to say, Mark Rowan yesterday was pretty brilliant on this point, and whether you agree or disagree, the point that there is something deeper that's been going on for a longer period of time where dissent has been drowned out, and most people in certain universities do tend to agree, and that a lot of these universities do take a stand on certain moral issues and get everybody in line as sort of one voice rather than letting each person have a different view. How much is that a focus in Washington, D.C. is part of why there has been such divisiveness, such polarization in the political parties?
Well, it was a huge focus yesterday for Republican congressmen and women because they actually also wanted these university professors to talk about more conservative professors. And could they name some or have data and statistics about conservative professors within their college faculty? And these university professors couldn't. So to Mark Rowan's point, I think what he was talking about is the fact that potentially they have become too liberal and that they've become universities that are just allowed or preferred speech, not free speech. That is something we've heard him say to you guys yesterday, and we've heard him say time and time again, which is why you're seeing some of this uproar. Yesterday, we also spoke to a former university president of California, and what he was talking about is underlying culture and how some universities are getting it right when it comes to education about anti-Semitism, about Islamophobia, and others just aren't getting it right. And I have to say, within Washington, D.C., besides this hearing, the Biden administration, the president, he's put out statements about this. Shortly after, we've seen a lot of these incidents take place on university campuses, but also the Department of Education is actually having an investigation, a probe into Harvard and other universities about these incidents.
AMH, talk to me about how this might play out on the debate stage a little bit later.
Well, this is going to be easy for those four individuals on the debate stage to really want to attack what they would see progressive-leaning liberal universities, and also just say that the country, in their mind, is moving in the wrong direction, potentially using this issue to make that point. We should also note about the debate stage tonight, it is smaller, right? We have 4 contenders now, but the real show was last night. The leader of the Republican nomination, former President Donald Trump, was on television one-on-one with Sean Hannity for 60 minutes. And then these 4 are going to have to share the spotlight.
Let's talk about what the current president had to say about next year's race. Anne-Marie, telling donors that if the former president wasn't in the race, he probably wouldn't be running himself. We joked about this a little bit earlier. Then there was a cleanup on aisle 2024. Can you talk to us about that cleanup? What happens if the former president isn't the guy, isn't the candidate for the Republicans?
Well, then he came out to a reporter who wanted to clarify this comment when he made his way back to the White House from Boston, where he was attending 3 fundraisers, that, of course, he's not dropping out. If you talk to people, hear from people in the administration, they will say that, of course, the president feels this way. This was his whole reason for joining, for running in the first place. He felt the country was going in a dangerous direction under the former president and wanted to make sure there was someone there who could beat Donald Trump. He didn't want to see another 4 years of Donald Trump. And that was, his impetus for getting involved in the first place. Now it's a second time running, and he's running against that former individual. And he said the quiet part out loud, which was, I'm not sure I'd be doing this, basically, if it wasn't Donald Trump running against me. And I think the issue a lot of Democrats are going to have is, does that really rally the base of your Democratic the progressive wing of your party to come out and want to vote for you? Is that an inspiring message, especially when poll after poll continues to show that they think this president is just too old to run again?
So let's talk about the other one. You said that the main event was last night with Sean Hannity interviewing the former president, Donald Trump. And he kept asking, a friend of Donald Trump's, he kept asking him just to clarify that he was not going to be a dictator. He said, you are promising America tonight that you would never abuse power as retribution against anybody. Donald Trump said, except for day one. And he said it again, once more. What do you make of this? What's the sort of consequence of some of his discussion?
Well, Sean Hannity was, I think, trying to help him and explain, well, sir, what you're saying is that's not being a dictator, that's going back to your former policies, because then Trump explained what he wants to do on day one, which is close the U.S. southern border and drill, a.k.a. unlock U.S.'s energy resources. We should remind everyone that the U.S. is the biggest energy producer in the world right now. So I'm not sure that under former President Trump how much more even we'll get, but that's where the facts are. But Trump was just trying to, I think, play on some of the words that the Democrats tried to paint him. But it's obviously concerning because he has said in the past that this will be retribution, will go after everyone that's gone up against him. It's going to be an interesting year, to say the least, especially given the fact that he faces north of 90 federal charges.
I find the energy point just absolutely hilarious. So the Republicans get to sit there and say, let's drill more. And everyone in the White House is too scared to come out and say, we are.
Yeah.
At 13.2 million barrels a day, Bramo. They just can't say it.
This is going to be a really interesting talking point and debate when you do get 2 nominees, because if one person's going to say drill, baby, drill, and Biden's going to say,
we're not doing that. We're not doing that. That's not happening.
If that was happening, we would have record production, which is what we're already having.
AMH, thank you. It's good to hear from you. Always is. Anne-Marie in Washington, D.C., 13.2 million barrels a day. In America, in the White House, it's just like tumbleweed. It's just, we can't talk about that. It's not a talking point for next year.
And they're really playing it down. They're talking about the energy transition, how important it really is to invest in other things. And yet, around the margins, you kind of get the sense, all right, guys, come on, keep bumping a little bit more to offset any disruption from production, whether it's Russia or the Middle East.
Less politics, more markets coming right up. Equity futures on the S&P 500 positive by 0.1%. Weighing in on the credit market, the brilliant Amanda Liner of BlackRock. That conversation just around the corner. In the bond market, yields higher by 2 or 3 basis points, 4.19 on a US 10-year, a break of 4.20 yesterday. The data better than good. Job openings in America, the lowest level since March 2021. The mix in the ISM for services just almost perfect. The headline number robust. Prices paid a little bit lower. The bulls themselves couldn't have painted a prettier picture of the economic data in the last 24 hours.
Which is the reason why they're getting excited. Nirvana, soft landing Nirvana.
Rate cuts and growth is going to be okay. Stocks to the moon. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Large following on X, or what used to be called Twitter. Sure. Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Stocks on the S&P 500 just about positive by 0.1%. On the Nasdaq, we're shaping up as follows and look a little something like this, up by 0.1% also. Tech, it was kind of strange yesterday. We mentioned this in the last hour. Tech was actually okay beneath the surface, and yet we had a day of losses, Lisa, on the S&P 500.
If I'm going to give this a narrative, and I guess that's what we do here, I would just say the idea of softening growth leaves big tech still as the bright spot, given the fact that if companies have the ability to keep spending on anything, they're going to keep spending on artificial intelligence.
Softer growth, lower rates.
Exactly.
Kind of dream world for them, right?
Absolutely, especially with valuations, given that they're going to be propped up a little bit by lower rates. Just all nirvana.
Is that right?
Ugh,
you don't quite believe it, do you? It's painful to say.
It is.
The rip-roaring rally we've had in this stock market is just painful for Bramo and deeply
all right.
personal.
No, hold on a second. It's not that it's painful. I think it's wonderful people are coming up with gains. The issue for me is the lack of skepticism and the sort of feeling of, okay, this is the reality that we have. We're not going to see any pain. It's all going to be perfect. Just feels a little bit mispriced.
Do you want some more time?
No, it's good. Carry on.
No lack of skepticism here around this table this morning. Let's turn to the bond market. 2-year, 10-year, 30-year. Think about the journey. This is for you, TK. The journey we've been on a 2-year. Middle of October, 526. Back down to 460.95. In the 450s yesterday. Yields up 3 basis points today on a 2-year. On a 10-year, it's a break of 420. We were through 5% in October. 419.34, Lisa, on a 10-year this morning. Up on a session by 2 or 3 basis points.
80 basis point drop since the peak on October 19th. I was looking at this and I'm thinking to myself, that used to be a massive move, and now it just sort of snuck up on people. And this idea that we've seen this incredible volatility, is it over with people coalescing around what could be, soft landing nirvana?
I'm going to talk to Sabancı Rejappa of SocGen about this a little bit later. We've still got a massive deficit that needs to be financed next year. It's funny, the stories you heard when yields were at 5% on a 10-year and the stories you hear now with yields at 420 on a 10-year are just radically different. And we're talking about the space of what, 6 weeks? 6 weeks.
The problem is that they all could be right. The narratives all make sense. The logic is consistent. So that's the problem. How do you then coalesce around what kind of view to look at? Which is the reason why Binky was saying, well, if you just look at the earnings, companies are still doing okay.
Binky over at Deutsche Bank, Binky Charter, looking for 5,100 on the S&P 500 year-end next year. Let's get to the euro, because Deutsche Bank think we get 150 basis points of cuts from the ECB.